Hello there. I hope that you're doing well. Welcome to the first lecture of the swing trading series. During this series, I will explain to you how you can apply the concepts which I've taught you on the lower time frames to the higher time frames if you're interested in participating in swing trading. Before you watch this lecture, I want to make it known that this lecture is not meant to watch as your first lecture of my mentorship. Meaning, if you're completely new to my mentorship, I highly suggest you to look at my older lectures first, such as the model series and such as the other typical lectures, such as the predicting price series. The reason why is because during this lecture series, I will be speaking to someone that has gone through the majority of the content released prior to this series, since there are a lot of similarities when it comes to how I've taught you to look at the lower time frames and how I will teach you to look at the higher time frames. When it comes to swing trading, a lot of people think that swing trading is completely different than lower time frame trading. However, the only thing that is different is the duration of the moves playing out, because time is time and price is price. Both are fractal. So with that being said, let us begin with this first episode of the swing trading series. This is the first series for the 2025 mentorship. Who is this series for? This series is meant for the trader that does not want to trade intraday volatility and is much more inclined to focus on higher time frame price swings. This trader is comfortable with being in positions for days, weeks, and maybe even months. Meaning, this trader is comfortable with being in a position for a rather long time compared to an intraday trader. Where an intraday trader could be in and out of the market within less than 30 minutes, for swing trading this is of course not the case. Therefore, you need to have a lot of patience. Time frame alignment. The time frames that we will be utilizing during this series are the following. We will be paying attention to the monthly, weekly, daily, H4 and hourly charts. The higher time frame analysis will take place on the monthly, weekly and or daily charts, meaning these are the time frames which we're going to utilize in order to frame our higher time frame analysis for the swing trades. The execution time frames, however, are going to be the daily, H4 and or hourly charts. During this series, my goal is to provide to you a swing trading model which can be applied across all markets, regardless of time frame. Meaning, you can literally just pick the market that you're interested in and you can look for the signatures which I will be teaching to you. The signatures, again, are very similar to the lower time frame signatures because all we are doing is increasing the duration of the time cycles which we're using and the size of the price ranges which we're using. Yep, the size of the price ranges, you heard it right. And therefore, the way that we're going to look at the markets isn't going to be really different. So if you're into swing trading, don't think that all of the other content on my mentorship is completely irrelevant, because it's not. Even if you're not interested in swing trading, particularly meaning if you're still interested in intraday trading, this series is still going to be beneficial to you because it's going to teach you how to properly frame a higher time frame analysis and how to know where the markets are drawn towards on the highest possible time frames. The expectations for this series should be as follows. Swing traders take around 1 to 2 trades every week or every few weeks, depending on the time frames that they're trading upon, of course. All a swing trader cares about is where price is drawn towards from A to B within the upcoming week or weeks. Position size is smaller than day trading due to bigger invalidation sizes, meaning the amount of points or pips between the entry and invalidation is of course way bigger for swing trading than for intraday trading. Therefore, position size accordingly. With swing trading, the same trading concepts apply, but within a much bigger time cycle. With that being said, what I will share with you is some chart examples of swing trading opportunities. And I'm going to walk you through the use of bigger time cycles and the same concepts as we do on the lower time frames, but now on bigger time frames. Now, for all the examples which you will be shown during this series, I will be referring back to analysis which I've shared in real time throughout 2024. The reason why I'm doing that is due to the following. There are a lot of people nowadays that teach these theories, they teach these concepts on the markets, and they go out here and they say, look, this is when and where it happened, and they just pick random examples. What I am, however, doing is I'm only showcasing examples to you which I literally called in advance before they played out. Meaning, the example which you are shown right now is the sells which took place on Euro throughout the fourth quarter of 2024. If you're completely new to my mentorship and you haven't watched the market reviews of 2024, you can go back to those market reviews and you can listen to the market reviews in which I was calling that we would likely see Euro be repriced towards the downside soon. That is the first breakdown which we're going to take a look at. What I want you to see is that Euro was consolidating. Euro was stuck inside of this range from high to low and was going back and forth, back and forth. When the fourth quarter then came, what we saw was that Euro began expanding towards the downside. When we pay attention to the high of this range, you can see that the high was the 2023 high. Because we were trading in 2024, we pay attention to the previous year's high and previous year's low. This low, however, was not the 2023 low, but that doesn't matter. Why not? Because this low formed after the 2023 high was established. This resulted in consolidation taking place. Therefore, I look at this low to be the low of the consolidation. What you can see is that the market expanded in close proximity to the 2023 high, but it did not take it out, and it still reversed and draw towards the downside, drawing towards this sell-side liquidity pool and this imbalance which was present right here. You might be like, why did that occur? There's no purge of the 2023 high. How were you still anticipating lower prices throughout the fourth quarter then? When we pay attention to Euro, its respective weekly chart on the left, and GBP, its respective weekly chart on the right, what you can see is that Euro was repriced towards the upside and it stopped right in advance of the 2023 high. When we, however, pay attention to GBP on the right, what you can see is that GU was repriced higher above the 2023 high. Therefore, we saw yearly SMT taking place between Euro and GU. We then saw the signs of a reversal taking place. Notice that a bearish breaker formed, where we saw a high form, low, inside of a small BC, higher high, lower low. This down close candle is now your bearish breaker. When we pay attention to GU, we also saw a bearish breaker form, where you can see that we formed this BC. We then formed a high. The market retraced into that BC, expanded higher, and we then saw the market close below this low, the low which formed inside of this BC. See a retracement taking place multiple times into this candle right here, and the market is rejecting that candle multiple times before expanding lower. Now, the main takeaway from this is the following. The main takeaway is that because we have that bigger time cycle SMT, that yearly cycle SMT, we can anticipate that we're likely going to draw towards the opposing side. What is the opposing side? The opposing side is, of course, sell-side liquidity. Because who is making money all throughout this repricing higher? Buyers, of course. Therefore, we can anticipate that to end the year, we're likely going to see sell-side delivery next. And that is why I was leaning towards the downside throughout the fourth quarter on Euro and GU. And this was paired with a very bullish door analysis as outlined. And that is something which I really suggest you to go through the reviews of 2024 and investigate. But with that being said, let us pay attention to the... it sounds weird hearing me say this, because I'm going to say lower time frames, but we're still going to pay attention to a daily chart. So you're going to be like, how could a daily chart be a lower time frame? Put things into perspective, guys. We came from a monthly chart. So relative to a monthly chart, the daily chart is, of course, a way lower time frame than the monthly chart. And that is why I'm referring to the daily chart as our lower time frame chart now. Everything is fractal, guys. When we pay attention to the daily chart then of Euro, what you can see is that I've put the risk to reward tool here and I've put a CB right here, which I've annotated. Notice that we saw that purge of this high form right here. We saw a purge of buys liquidity taking place. And we then saw intermarket relationship between euro and the dollar. And this is what I need you to investigate on your own charts, by the way. I've decided to not annotate this because I want you to go into your own charts to see the level of detail right here. What I want you to see on your own is that when you compare euro to the dollar right here, you will see that there was a very tiny SMT right here. So we were aware of the fact that we had that bigger SMT relative to this price level right here, relative to that 2023 high. And we saw the market eventually then roll over. It began to show the signs of bearish order flow stepping in. We saw a breakaway gap form and the market displaced through this low. This low was the previous month's low. Therefore, we were anticipating that as long as this low would function as resistance on price, we could anticipate lower prices to take place. Notice that when we saw the market retrace, we failed to retrace into this low, meaning the market never retraced throughout the month of October into the September low. That right there is screaming bearishness for the remainder of the quarter, and that right there is showcasing to you that they're likely going to reprice it towards all of the sales liquidity engineered below these lows. Because when you pay attention to these lows, you can draw a very clear trend line and extend it to the right. So everyone was bullish on euro, everyone was anticipating higher prices. But when the time was right, IPTA had other plans. Now, the daily chart could have been utilized for an execution for a swing trade, because the retracement into this CB right here is already an IOFET, an institutional order flow entry drill entry, as you can see. The invalidation for this idea is this CB right here. We wanted to see this CB be left open. This CB is our breakaway gap. The reason why is because this was our previous month's low, the September low. So this candle has to function as resistance on price, but this is also a bearish breaker. So you have multiple things lining up there that showcase to you that this downclose candle should never get displaced through. And that is why we can enter in this CB, but we must allow for the market to retrace into that low before potentially expanding towards the downside. Now, when it comes to the management of this position, you might be wondering, how could this trade have been managed? Well, what I want you to see is that the market expanded very quickly away from this CB right here. When this expansion leg lower occurred, what you can do is the following. The moment that price expands lower and it displaces through imbalances on the left side of the curve right here, your stop can be drilled from the breakaway gap where it was placed initially to the entry, meaning you're removing risk on this position, and the next retracement which takes place, so for example this retracement higher into this old retracement on the left side of the curve, meaning pay attention to this retracement leg lower. On the buy program, what I want you to see is that there are a lot of retracements, right? There are a lot of back and forth goings on the buy side of the curve. We can extend these retracements to the right to determine the ranges that price should not displace above if bearish. Therefore, pay attention to this high, to this low. We can extend that to the right, and the moment that the market closed below that range, we want to see that range function as resistance on price. It's a must, and therefore our stop can be drilled to break even, because the market should never come back above this high again. It has absolutely no reason to come above that high unless our idea is wrong. And this is how we can enter based upon the daily time frame. Now, throughout the month of November, we of course had the US elections, and that is why you saw this big expansion leg lower taking place afterwards. But this was the most ideal entry for this swing position throughout the month of October. Now, with this bearish idea in mind, you could either execute of the daily time frame, but you could also zoom into the hourly time frame and try to fine-tune your entry. Now, because this is a position which is likely going to run for a few months' time, this is not the type of situation in which I would suggest you to go into the hourly time frame. The reason why is due to the fact that if you try to fine-tune your trades too much, you are actually making it harder for yourself to get into these type of moves. Because if you would just focus on participating in the market move from a higher time frame swing. I'm not telling you to go out here and invest and trade for your info, but I'm just speaking in terms of if you would decide on your own to participate in a higher time frame swing like this, where you're holding onto a position for weeks, if not months, right? Why would you go into an hourly time frame and try to fine-tune it onto a 15 or even 1 minute time frame, right? It's overkill in my opinion. And the reason why is because the returns on this trade are already phenomenal. If you participate in a swing trade like this every quarter, do you need to do more than that if you size properly? Of course not. And that's the whole paradigm that a swing trader has, where a intraday trader is participating in market moves multiple times a month. A swing trader doesn't have that mindset because the position size behind the positions is smaller, right? But the amount of points, or in this case pips, that are being captured are way bigger than an intraday trader. And therefore, the risk per position can also be increased in terms of percentage due to the amount of executions which are taking place. But that's something which we'll discuss later during the series. We're now going to take a look at Nasdaq buys which took place during the second quarter of 2024. What you can see is that I've plotted the yearly open utilizing the time cycles indicator, and next to that I've plotted the monthly and weekly open. Next to that I've annotated specific imbalances, this BC and this CB. What you can see is that throughout the first quarter, we saw the Nasdaq expand towards the upside. But whilst we are looking at this expansion higher, you can see that there was a lot of back and forth going right here. Meaning there was a lot of chop, as I usually call it, of course. Due to this chop taking place, what we can anticipate is that at one point in time, we are likely going to see the market drop suddenly. We are likely going to see it gravitate towards all of the sell-side liquidity engineered below these lows right here. Because we can draw a very clear trend line, as you can see, below these lows. Therefore, when the second quarter opened up and we saw the market begin to drop towards the downside, we were monitoring the reactions to the falling range. We're monitoring the reactions to this specific BC right here. This BC was important because it displaced through the yearly open. The market dropped below the yearly open and it dropped into that BC's range after having taken out sell-side liquidity resting below these lows. We saw the market then form a low and it began repricing towards the upside. At this moment in time, it is however not confirmed yet that we have in fact seen a change in the state of delivery on the higher time frames and that we're going to see a byproduct month fold soon. We see the market retrace and a new month opens up. The month of May opens up and the market initially drops lower below the opening price and it then begins to expand towards the upside. It begins to run higher. Notice that it displaces through this CB right here. This CB is very important, and the reason why the CB is very important is due to the following. When we pay attention to the left here, you can see that CB displays through this low. This low is important because if we look to the left again, notice I'm moving to the left twice here, one time, two times, we can see that the low formed inside of this BC. If we would have seen the market find resistance inside of this CB, inside of this down close candle, or inside of this BC, then we would have anticipated lower prices. But because we close above this CB and we form a new BC here, we can anticipate that we're likely going to see a retracement into that range before further continuation higher is taking place. Why? Because when we pay attention to this original consolidation, you can see a lot of back and forth going. And guys, because Nasdaq was trading at all-time highs, this is not how a market tops. Meaning, a market doesn't top out of a consolidation. It doesn't happen because this is the engineering of more buy-side liquidity. Retail mind traders are seeing bearish signatures. They are seeing bearish trend lines getting created. They are seeing resistance, so to say, getting reached. And therefore, we can anticipate continuation higher taking place once we have dropped lower first to trap retail into believing a swing high is in, so that we can then basically fill our long orders so that we can distribute against that. And that is the whole smart money paradigm. And it's about looking at the markets from a completely different perspective than the masses. Now, when we compare intermarket relationship, we can see that Nasdaq is shown on the left and ES is shown on the right. What you can see is that I've annotated the February low. And the reason why I've annotated the February low is because the February low is of course a monthly low. Throughout the next months, we are paying attention to this previous month's low to determine whether or not intermarket relationship is confirming to us that we're likely going to see a specific program unfold. What I want you to see is that Nasdaq dropped below the February low, whilst ES created a higher low throughout the month of April relative to that low. That right there is telling to you that a bigger SMT is in play. So the moment price displays as higher, it's the sign, all right, we're in a buy program officially now. And that is one of the main takeaways that I want you to understand within this first lecture of the swing trading series. Pay attention to bigger time cycles. Pay attention to yearly highs and lows. Pay attention to quarterly highs and lows. And pay attention to monthly highs and lows. And when you see a big SMT with a highly correlated or inversely correlated market, that right there is the first big warning sign, if applied within the proper narrative, of course. Here we're on the 4-hour chart of Nasdaq. And as you can see, I have annotated that daily CB with this blue box. I've extended it to the right. What I want you to pay attention to is what is occurring right here. Notice that throughout the repricing outside of that daily CB's price range, multiple imbalances are forming on the 4-hour chart. Meaning you can see that the market displaced really on the hourly chart above that CB's range. And the creation of these imbalances is showcasing that to you. Notice that the market then retraces into that daily CB's price range. And what you can see is that we repriced into that daily CB and then rejected it right away. Notice how the market is reacting off the higher end of this bigger blue box. As you can see, I've placed the RR tool inside of that daily CB's price range. And I've placed the stop loss, the invalidation, below this low. The reason why this low is important is because for this specific week, this was Monday. And in a trending environment, and an environment in which we're anticipating a low resistance liquidity run towards the upside, we are anticipating that the previous day lows, and in this case especially the Monday low, is likely going to be left intact. Why? Because we have a sequence of imbalances which formed right here through that daily CB. Therefore, the retracement into that specific range is a potential entry, and the invalidation for this idea would be if price would displace below this low, and that is why our invalidation can be placed there. If we pay attention to time more, you can see that entry took place throughout the New York morning session, where we dropped lower into that specific daily CB's range, and into the sequence of imbalances throughout the New York morning session. And that right there is New York reversal daily profile. And this right here is where we're entering simply based upon that higher time frame point of interest. Where as a intraday trader, we would be zooming into the lower time frames, looking for a market maker buy model opportunity. As a swing trader, we're simply entering it here with a wide enough stop, and we're targeting our higher time frame objectives. Now, this right here is a method of entering which is quite, I would say, unfamiliar to the majority of you. And that is because you have always been taught to look at breakers and mitigation blocks by me. However, when you're looking at swing trading, you're not going to go into the 1 minute time frame and look for your entry if you're trading a swing which is likely going to take place over a couple of days or weeks. I'm not saying that it's not possible, but I'm saying that it's way more stress-free in order to just enter off the higher time frames. And that is what my focus will be throughout this lecture series. And what you can see is that the market expands into the anticipated direction of that drawing liquidity of that old all-time high. And when that gets taken out, you see further continuation taking place eventually. Now, what is so important to note is that when it comes to swing trading, you need to submit the time. Meaning you need to allow for the market to retrace multiple times into your entry area before you see the expansion taking place. And with that, I want to end this first episode of the swing trading series. During this episode, I have provided to you a general idea of what swing trading is like and for who this series is meant. And I've also provided you with multiple examples of what swing trading opportunities look like. During the upcoming episodes, I will teach you more when it comes to objectifying your swing trading approach and how to actually determine the drawing liquidity and how to get in sync with these price swings by icttrading. I hope that you enjoyed this first lecture of this new series. And if you are an intraday trader, I'm sure that you took some gems away from this. Just apply a different time cycle, different time frame, and the same logic applies. I want to wish you all the best, and I look forward to catching up with you in the next episode. Be safe. Hello there. I hope that you're doing well. Welcome to the second episode of the swing trading series. During this episode, I will be discussing intra-week trading. This style of trading is, in my opinion, likely going to be the most sought after swing trading approach for the majority of viewers of the series. The reason why is because this style of trading is a balance between intraday trading and longer term trading. This style of trading is ideal for the person that is working a full-time job and doesn't want to spend much time behind the charts, but still wants to make his or her analysis and take trades based upon that. With that being said, let us begin this episode. Intra-week trading. First of all, for the higher time frame analysis, when it comes to this style of trading, we will be paying attention to the weekly and daily charts. The times of interest for this style of trading will be specific days and specific sessions. This is something which I will discuss later during the series more in depth. The execution timeframes for this style of trading will be H4 or hourly charts. Personally, I prefer hourly charts, and that's a result of me preferring more candles when I'm looking at the charts than less candles. However, if you would like to use less candles within your analysis, then you would use the H4 chart to execute upon. The higher time frame analysis. In order to establish your higher time frame analysis, you must first understand everything which we need to look at in order to come to the conclusion what the underlying drawing liquidity is and what the underlying narrative is. Therefore, I highly suggest you to go back through the model series, and as outlined during episode 1, this series is not meant to be first watched when you come to my mentorship. I highly suggest you to first go through that model series before you go through this series, because I'm speaking to someone who already has a certain understanding of the way I approach the markets. However, when it comes to the higher time frame analysis, what's very important is that we first of all base this on weekly and the daily charts. Meaning, based upon the weekly and daily charts, we establish, alright, what are the markets likely going to do next? What are they drawn towards? What is our drawing liquidity? We determine key liquidity pools, meaning we determine key time-based liquidity pools. Think about, for example, yearly highs and lows, monthly highs and lows, weekly highs and lows. And next to that, what we do is we pay attention to the weekly and daily arrays that formed. Think about weekly or daily imbalances, or weekly or daily breakers, or mitigation blocks and such. When you begin aligning key liquidity pools with weekly and daily arrays, what you will begin to notice is that liquidity gets engineered in advance of these weekly and daily arrays. And therefore, you know that that liquidity pool which you're targeting is a very strong drawing liquidity when the underlying order flow is signaling to you that that is the draw. Times of interest. When it comes to the times of interest of intra-week trading, we mainly pay attention to specific days of week utilizing the economic calendar. We pay attention to the days with high impact news. Those are the days we focus on. The reason why is because on these days we know that volatility will get ejected, and we also know when it will get injected. The session of day is usually the London or the New York morning session that we look to focus on. Meaning we don't look to trade Asia. Meaning we don't look to trade the New York PM session. We purely focus on positioning ourselves inside of the markets during either the London or the New York morning session on these specific days that we have interest in. We don't care about anything else. And this is how we use the times of interest. Notice that I'm not dropping down into smaller time cycles such as 90 or 30 or 10-minute cycles. No, all we need to know is where's price at for the current session. And when we have that established and it's aligned with our underlying narrative, we can anticipate that the time is now right for the next delivery profile to take place. Let us pay attention to some examples and this will all be clarified for you. I'm a big believer in the fact that when you get introduced to theory and when you get introduced to bullet points like I just described to you, that you need to see them visually applied and that you need to watch over my shoulder whilst I'm applying the logic which I just described to you. Because if you would investigate what I just described to you next to everything when it comes to, all right, this is how we establish our narrative, this is how we establish our draw liquidity, this is how we establish a point of interest. All these things have been taught within the model series. If everything within the model series is clear to you, and instead of dropping down into the lower time frames, you would just stick to the RE chart, man, oh man, you're in for a treat because you are going to see that intra-week trading might actually be something worth considering. Now, here we're on the weekly chart of Nasdaq, and what I will do is I will walk you through some examples on Nasdaq and GU of basically intra-week trading opportunities presenting itself. What I want you to see is that throughout 2021, Nasdaq was repriced towards the upside. Notice that every single expansion was followed by a retracement, followed by a new expansion, followed by another retracement, followed by a new expansion, followed by a new retracement, followed by a new expansion. This right here is of course the characteristic of bullish order flow. Higher highs, higher lows being made when we speak in layman's terms. However, what I want you to see is that throughout November, Nasdaq was unable to continue this underlying bullish order flow. We saw the market begin to consolidate. When 2022 then opened up, what we saw occur was that Nasdaq displaced towards the downside. Notice that this sequence of imbalances formed. You have the first imbalance which formed up here, the bearish value gap, and the second bearish value gap formed here. But why is this sequence of imbalances so important? It's so important because this sequence of imbalances formed whilst Nasdaq was repriced below this low. This low was so important because this low set up the final run higher. Notice that this low was utilized to reprice above this high, above the buy side liquidity resting above this high. Notice that throughout this leg higher, multiple imbalances formed. And as you have learned within the model series, you know that when these imbalances get overrun, and preferably new imbalances get created on the opposing side of the curve, that's a very strong characteristic of the underlying order flow changing from, in this case, buy program to sell program. Notice that I've annotated this weekly CB right here. The reason why I've only annotated this weekly CB is because it formed inside of this down close candle, which is your bearish breaker, of course. When we pay attention to the daily chart then, what I want you to see is that I've annotated the January high and the January low, and next to that I've annotated the February open. What you will learn throughout this episode is that we can utilize opening times in order to fine-tune our entries. When it comes to positioning ourselves short inside of a market that we anticipate to draw lower, meaning in a bearish market, we ideally look to position ourselves short above either the monthly or weekly open. What you can see is that when February opened up, we repriced higher into the higher end of that weekly CB, formed the high of the month there, and then Nasdaq began expanding towards the downside in this initial run lower right here. Do you see that? You see that we form this high and then this first drop lower takes place. Notice, however, that this drop lower was not sustained, meaning the market came back above the February open one more time. So what does that provide you with? It provides you with opportunities to open swing positions on the downside, meaning short positions. When on specific days of the week that the economic calendar is suggesting to us that we should anticipate certain price movements to occur. Notice when the market trades above the February open, it isn't taking long before it rejects it. We spend just a few days above it, and then the market displaces lower and it begins the sell program. What is the market drawn towards? It's drawn towards this sell-side liquidity pool of the January low. Notice that a new CB forms right here. Retracement into that CB and into that weekly CB takes place again. This is again a shorting opportunity on the lower time frame. And what I want you to see is that I'm consistently looking for market maker sell models because I established that the underlying order flow changed when we displaced below this low. This low is that weekly charts its respective low. And because we repriced below that low and we saw those imbalances form throughout that leg towards the downside, it tells to you, all right, we're likely going to see sell-side delivery taking place next. When we then pay attention to the hourly chart, what I want you to see is that when we opened up for the month of February, we initially saw the market consolidate around that open, and we then saw the market expand towards the upside. Notice that it traded above that weekly CB price range right here. Wednesday opens up, and what is so important about Wednesday? What's so important about Wednesday is that we open up by this vertical line right here, and we initially run towards the upside. Why is that run towards the upside important? You might be wondering. Because just like I described to you the importance of the monthly and weekly open, we can also utilize the daily open to even fine-tune our entries even more. What you can see is that the market expands higher initially, retraces, and then has one more push towards the upside. When does this push towards the upside take place? During the New York morning session, during the AM session. And when you pay attention to what took place throughout the morning session, you will see that at 8:15 AM there was high impact news. Next to that, there were OPEC meetings all day, but it is the high impact news at 8:15 AM which is so important because that is a volatility injection which we can use to basically monitor, all right, are we going to form a weekly high in this area? Notice that when that news release took place in this down close candle right here, we saw the market expand lower. Notice that the next candle opens high, back into this low, and then immediately expands away. It draws towards the downside. Notice that we are now drawn towards sell-side liquidity next. Why? Because a change in the state of delivery occurred the moment that price displaced below this low. Don't look at the trading above this weekly CB's range of this blue shaded box as, oh, now Nasdaq is bullish, now we're going to run higher. Why not? Because this is manipulation which is occurring on that day where we have high impact news inside of a week of NFP. We look to position ourselves before the end of Wednesday's morning session. And then we let everyone gamble throughout the remainder of the week in advance of NFP. Our focus is on the end of Wednesday's morning session. If we are able to find a swing opportunity in advance of the end of Wednesday's morning session, we can leave that position running all throughout the week. And what you can see is that when the market expands lower like this, what is it drawn towards first of all? And what would be the first logical partial objective? Well, I want you to pay attention to this low right here. This low was the low of that consolidation which occurred around that February open. But when you pay attention to time, you will see that this was your previous day low. When you pay attention to the range between the potential entry in this area and the potential take profit right here, you will see that this is a massive range on the downside. And this is exactly what we're looking for. Because let's say that your stop loss is placed above the swing high. It's the easiest way of defining your stop loss. Don't worry, I will explain more in depth on how to actually utilize entry patterns when it comes to intra-week trading. But for now, I'm just explaining the overall frameworks to you. And notice that patterns for entering are details. At the end of the day, the entry is the least important. What is important is that you understand the underlying narrative behind why something should occur. Why should Nasdaq draw lower now? Why should it begin to reprice lower? Why should it begin to roll over? Because when that is clear, any retracement higher can be looked at as a potential shorting opportunity. So what I want you to see is that the range between the potential entry in this area and the objective is of course pretty huge. And when you start intra-week trading, your focus shouldn't be on capturing 4, 5, 6, maybe even more trades. No, just focus on 1 or 2 good moves and be done. Don't look to do more than that. The reason why I mentioned that you shouldn't try to do more than 1 or 2 opportunities is because every single week there are about 1 or 2 opportunities that are so clean that you can anticipate coming in advance based upon the economic calendar and how the market is delivering towards that specific day that you have interest in, where you can say, all right, this is likely going to happen next. And those are the type of moves that an intra-week trader is interested in. Notice as well that on the lower time frames, this is where your market maker sell models would present themselves on the 1-minute chart. Now, when we pay attention to that opportunity which presented itself later throughout the month of February inside that weekly CB, you can see that I have plotted the economic calendar again right here for Thursday. And what I want you to see is that throughout the morning session, the CPR release took place at 8:30 a.m. Now, when we pay attention to this weekly delivery profile, what you can see is that when the market began delivering for the week and we saw the market open up, we initially saw a drop lower right here on Monday and Tuesday. Then throughout the middle part of Tuesday, however, a low formed and the market began expanding towards the upside. Notice that throughout Wednesday, this expansion continued, but throughout the latter part of Wednesday, a high formed and the market began consolidating, began going sideways. Where is it going sideways? It's going sideways in a premium of that weekly CB. And when you pay attention to price, you can see that's going sideways around that 17,000 big figure. If you are aware of the advanced price ranges, you will understand that this is a very important price level to monitor. Now notice as well that price is consolidating inside of this large CB from that initial expansion which we monitored. Therefore, what we're interested in seeing is, all right, how are they going to run with the CPR release? What are they going to do with that? What I want you to see is that in advance of the morning session on Thursday, nothing really happened. The market just consolidated. However, when that CPR release took place inside this down close candle, you can see that we initially repriced higher and then had this sudden drop towards the downside. A retracement occurs, but notice that the market didn't retrace all the way back into this candle's low. Therefore, a RECB is being created. The market retraces into that CB, and this right here, yes, is where an intra-week swing trader would look to position themselves short. And the reason why is because they understand that first of all, price is trading above the February open. The higher time frame order flow has changed, meaning we're anticipating lower prices for the remainder of the month to come. And next to that, what you can see is that relative to the economic calendar, ictt is tipping its hand to you, meaning it's tipping its hand through the creation of this CB on the RE chart on the day of CPI. And when you pay attention to these lows right here, notice how smooth these lows are. Notice that these lows are below that weekly CB of that blue shaded box. Therefore, a intra-week swing trader would look to short inside the retracement into this red box, and they would place their stop losses above the high of this candle right here, because this is the highest high inside of these three candles which set up the creation of the CB, as you can see. Candle 1, candle 2, candle 3. Therefore, this high should remain intact. And that right there is one of those key algorithmic signatures which you need to understand. And notice that I'm not even discussing intermarket relationship with you just yet. Notice that I'm not even discussing the fine details within this price action with you just yet. All I'm doing is I'm explaining to you, all right, this is the framework which you can utilize to already begin thinking like someone who is looking to capture the majority of the weekly range. Because what you need to understand is that what this style of trading basically allows for is to stick to the hourly chart and execute based upon that without having to worry about 1 minute market maker model fractals. So it's basically stopping where an intraday trader would go into the 1 minute chart. And someone who's interested in participating in the full week range would allow for a bit more room when it comes to his or her stop loss and, of course, the invalidation. But next to that, what they're also doing is they're targeting a bigger objective. And that objective will get reached during more time. And that's the true difference between intraday trading and intra-week trading. And that is something which I want you to think about as well moving forward. What style of trading suits you best? When we pay attention to a bullish example, then what we will do is we will pay attention to the weekly chart of GU. What you can see on this weekly chart of GU is that GU expanded towards the upside throughout 2023, and it then formed this high right here. A sudden drop lower took place, and notice that a new low formed in this area. Notice that after this low formed, every single down close candle began functioning as support or price. This is a sign of bullish order flow. Notice that the premium range which formed on the left side of the curve right here failed to function as resistance on price. Therefore, what we're anticipating is that we're likely going to see a new leg higher taking place. What I want you to see is that the market consolidated in this area and just went back and forth for a while. 2024 opened up and we initially saw the market drop lower. A run higher occurred, and what you can see is that the market took out buy side liquidity, and what you can see is that a new high formed and the market dropped lower. In what did it drop lower? It dropped lower into this old down close candle. Notice how the bodies are respecting that down close candle right there. Notice that this down close candle formed in the lowest CB right here. Notice as well that the down close candle formed inside of this bearish breaker. This bearish breaker is an inverted bearish breaker because price displaced above it. Therefore, we anticipate it's likely going to function as support on price. And that's something which I've, of course, discussed more in depth throughout the 2024 mentorship. But I will discuss inverted breakers more as well throughout this series, probably when I'm explaining to you, all right, what are we looking for when it comes to confirmations of order flow changing? Because when you begin to understand inverted breakers and inverted mitigation blocks, a whole new world will open up to you, because all of a sudden it will become clear to you when IPTA is allowed to expand towards a specific high, when that high isn't necessarily a clean consolidation. Because in this case, this is not an original consolidation as you know it. It's not like, oh, you see a clear consolidation and you know, yep, that is where buy side liquidity is resting. No, it's just two candles higher and then followed by this sudden drop lower. But you still need to understand that this is where buy side liquidity is resting. This is where retail minded traders are seeing resistance right here. When you pay attention to this high right here, it's exactly the same fractal, where you see one big up close candle. That is your buy side liquidity engineered, and that is all we're looking at. When you pay attention to this high, it's exactly the same. When you pay attention to this high, it's exactly the same. When you pay attention to this high, it's exactly the same. But this is where those key buy side liquidity pools that are time-based come in play. And that is why you need to hover over swing highs to see, all right, what is the time when this swing high formed? Because this high, guys, was the 2023 high. So throughout 2024, what high are we referring to? We're referring to the previous yearly high and low, of course. And when you pay attention to how the market reacted off this down close candle, look at how the bodies were respecting that, it shows to you that the underlying order flow is likely going to begin being bullish soon. Displacement higher occurs and this weekly imbalance forms, this BC. But notice that whilst this weekly BC is forming, the market is also trading above this low. Why is this low important? Because we see a high, low, higher high, lower low. Therefore, the final down close candle inside of this low formation before this push higher took place is a bearish breaker. Price displaced above that with this BC, so this is now an inverted bearish breaker, which we can utilize as support on price to anticipate repricing higher to occur. And this is again how you can see the importance of keeping certain arrays on your chart. Notice that the market expanded higher and it took out the buy side liquidity resting above this high. Notice that a new retracement unfolded and the market traded back into this weekly BC. Notice that the market found support inside that BC and it then expanded above the 2023 high, which was right here, of course. Notice that when this high was taken out, a BC formed throughout the run towards the upside. Actually, two imbalances formed, but I'm annotating the highest one. And the reason why I'm annotating purely the highest one is because this highest one has to function as support on price in order for the next displacement leg higher to occur. That right there has to do with the price on the right here that this BC displays through, and the fact that when we are looking at continuation to take place, we are looking at the second imbalance that formed to function as support on price in order for the underlying order flow to remain very bullish. If GU would have retraced deeply, then it wouldn't have been a sign that we would have been a fan of for that continuation idea. But what I want you to see is that a new high forms right here. The market retraces. It retraces into this weekly BC right here. Notice that when this weekly BC was reached, a low formed and the next leg towards the upside took place. On the lower time frames, this is a market maker buy model fractal. And that right there is looking inside of fractals, and that is a skill which you need to develop. When we pay attention to the daily chart then, what I want you to see is that I've annotated the September open right here. And as outlined prior, but in first now, because we first looked at bearish examples on the Nasdaq, we're now looking at a bullish example on GU. So what we will do is we will say, all right, well, in a bullish market where we're anticipating higher prices, we are looking for the following to take place. We're looking for the market to drop below the key open. And when it drops below the key open and it shows to us that the time is right for continuation higher to take place, that is where we try to position ourselves long for that continuation idea to play out. Because what is resting above this high? Newly engineered buy side liquidity, guys. When we pay attention to the hourly chart then, what I want to see is that on the hourly chart, you can see that the market delivered towards the downside. We can see that there was a lot of back and forth going inside of the higher end of that weekly BC right here. On the Wednesday, on the 11th of September, what you can see is that the CPR release took place. Notice that the CPR release took place right here in the beginning of this sequence of down close candles. And the reason why I'm mentioning this in particular is because inside of this sequence of down close candles, retail-minded traders are being taken out when it came to their long positions that were on earlier. Sell side liquidity was engineered below these lows. But next to that, these down close candles are also trapping retail-minded traders into believing that GU is likely going to continue dropping. They look at that and they think to themselves, all right, it's time to go market short on GU now because it's very weak. It's time to basically go to zero, right? It's time to keep on dumping. But that's exactly what we are looking for, because that right there is manipulation. And what flows after manipulation? Always distribution, guys. Notice that I've annotated the lowest CB right here. And the reason why I've annotated the lowest CB, the final CB which formed, is because what you can see is that this CB was utilized as an inversion to value gap on price the next day on Thursday. Notice that throughout the London session, the market formed the low of day, where below the midnight opening price. And that throughout the morning session, the market let this low intact. Notice how it found support inside of this wick right here. Now you might be wondering, where can I look to enter? How can I look to position myself long? Well, in this case, what you can look for is you can look for this CB to be utilized as an inversion for value gap. Meaning you can look to go long inside of this CB the moment that IPTA is showcasing to you, all right, we're displacing higher. It's a buy program which is going to unfold soon. You might be wondering, How do I know that the time is right for that buy program to unfold? The answer to that question, guys, lies in this annotated sell-side liquidity pool. The moment the price displaces above this low and this CB right here, it's IPTA tipping its hand to you and it's basically telling to you, yep, I'm going to deliver higher now. And that right there is one of those things that once you see it, you can never unsee it because it occurs across all time frames, across all markets, across all asset classes. Doesn't matter what time frame you're looking at. This is one of those applications of time cycles that's absolutely going to blow your mind when you begin investigating. And next to that, you might be thinking to yourself, but how do we know that this is the low of the week? How do we know that this is likely going to be the absolute low before the market begins expanding higher? Well, first of all, you need to understand that I've just described to you based upon the weekly chart why the underlying order flow was still bullish for GU. But next to that, you can see that the news of the CPI release was utilized to manipulate lower trading into that weekly BC. Guys, when you see an important news release like CPI get utilized like this, it's the perfect manipulation before distribution can occur. Note that the market reprices above that weekly BC, and whilst it leaves that weekly BC, this early BC forms. Notice that this is occurring below the September open. Market retraces into that early BC, and that was again an entry opportunity, but then for the next week, because on Friday we do not want to position ourselves in any new opportunities when it comes to intra-week trading for the current week. I'm not saying that's not possible to enter on Friday. However, you would have to hold through the weekend, and within the current environment, that is not ideal in my opinion because the volatility is just through the roof and the tensions are through the roof as well. And that's a result of the fact that there's a lot of chaos in the world, and therefore it only takes one crazy event to take place throughout the weekend, and what you thought to be a nice entry on Friday appears to be an absolutely chaotic entry the moment that on Sunday the markets open up, and that is not worth the risk in my opinion. However, let's say that you would look to enter in this area. This was again an entry opportunity inside of this RBC. Note that we have RE imbalances on the left right here as well, which could have been utilized. Now, the final example which we're going to take a look at is a sell program on GU. And this sell program unfolded throughout Q4 of 2024. What I want you to see is that I've annotated this high right here, which was the 2023 high, and I've annotated the low which formed inside of that weekly BC that we just looked at as a potential long opportunity to expand towards the upside. Now, what is so interesting about this delivery is the fact that we were looking for longs inside of this area, inside this market maker buy model fractal. Now, the final example which we're going to take a look at is a sell program which unfolded on GU. What you can see is that I've annotated again this buy side liquidity pool right here of that 2023 high. Notice that we just looked at this fractal to frame a buying opportunity right here intra-week. But notice that I've now annotated this low with the light bulb meaning the market structure shift. What I want you to see is that when the market expanded higher throughout this delivery right here, eventually a swing high formed. The time was right for GU to be repriced towards the downside significantly throughout the fourth quarter of 2024. When the market displaced below this low right here, and it functioned as resistance on price right here, it showed to us that the underlying order flow was now bearish on GU. The reason why was due to the fact that this low formed inside of this BC first of all, and next to that this low set up the final run higher before this swing high formation took place, and next to that this low formed around that 1.30 price level, and that's an important price level for GU. Now we saw the market displace towards the downside afterwards, and we saw this weekly CB form. Notice I've not annotated this weekly CB because that is not what I want you to focus on within this breakdown. However, you should be able to see that this is a bearish fair value gap which formed right here. Notice that the market retraced into that bearish fair value gap and expanded lower once more. Notice, however, that it stopped right in advance right here of this low. What is that? That right there is the engineering of sell side liquidity which has taken place. And notice that this low was the low which formed inside of this down close candle right here. And the reason why this is so important to note is due to the fact that when you begin to understand the engineering of liquidity, you'll be able to look at these markets from a completely different perspective, and all ambiguity will get lost, because all of a sudden you'll be able to explain exactly why the market did what it did, but more importantly, when it did what it did, when the time was right. Now, what we will focus on is the delivery inside of this repricing lower which occurred. Now, on the daily chart, what we are monitoring is the following. What we are monitoring is the reaction to this upclose candle. This upclose candle in particular is so important because in bearish order flow, we're looking for every single upclose candle to function as resistance on price. But next to that, this upclose candle was the final upclose candle before the market made this sudden drop lower. Therefore, we need to see it function as resistance on price in order for the order flow to remain bearish. If we would have seen GU this way, above this upclose candle, utilized as support on price, then a completely different game plan was in play. However, because we saw the signs of a swing formation taking place inside that upclose candle, it signaled to us that we were likely going to see the next leg lower occurring. Because this right here, guys, when you have a higher time frame key level like this, a higher time frame sell at liquidity pool objective, an old monthly low of months ago, and you see the market stop right in advance of that throughout the previous week. You have a previous week's low and a monthly low so close to each other. It's like, what else do you want, right? When we pay attention to the RE chart then, what I need you to see is the following. What I need you to see is that when we opened up this week, we initially saw the market begin to run towards the upside. It was in a rush to be repriced higher. Notice that multiple imbalances formed, but my eye is drawn towards this imbalance in particular. The reason why this imbalance in particular is so important is because this imbalance formed whilst the market was repriced into that upclose candle of the daily chart, its range, that red box. Notice that the market retraced into that BC. We then saw time distortion taking place. Market was just consolidating, was going back and forth in this area. A new expansion leg higher occurs and the market takes out the Monday high. But when? On Tuesday. Open high on Tuesday. We open, run higher, trap people into believing higher prices are next, take out buys at liquidity resting above these highs, form a swing high throughout the whole session on Tuesday, and we begin to see the market this way lower. Notice that this CB gets formed right here, the CB which the New York morning session retraced into, and then the market began expanding towards the downside. It was in a rush to begin running lower. This CB by itself was already a potential shorting opportunity due to the fact that intermarket relationship was telling to us that this would likely be the weekly high inside of the underlying bearish order flow on the higher time frames. Notice that the market displaced lower and a new CB formed right here. Notice that the CB formed inside the price range of this large BC on the left side of the curve. What I want you to see is that when we pay attention to this blue shaded box, the reaction to this blue shaded box will tell us whether or not the market is going to draw towards this red line, that old weekly low. Notice that the market consolidated near the lower end of that REBC. And then when Wednesday opened up, we saw the market open high, form the daily high, and then throughout the London session begin expanding towards the downside. The market was in a rush to be repriced lower. What was it drawn towards? Towards the previous week's low, which formed right here. Notice that when this low was taken out, the market began consolidating, began going back and forth for a while, and we saw the market retrace into this CB eventually with this wick. Notice that when the CB was reached, the market immediately rejected that and it repriced towards the downside on the next day. Now you might be wondering, where are the opportunities to go short? Well, the opportunities to go short based upon everything which you have learned throughout this lecture are up here inside of this CB, and next to that inside of the price range of this BC, which is being utilized as an inversion for fire gap. I will teach you later during this series how to actually use specific entry patterns, but at the end of the day, the entry pattern is the least of your concern. What matters is that you're able to frame the underlying logic behind why something should occur, and more importantly, when. With that being said, the second episode comes to an end. I hope that you found it insightful and I hope that you were able to learn something from it. If you did, please let me know. During the next episode, I will walk you through how to actually swing trade for days, weeks, or maybe even months in a row. And that is a style of trading which requires a lot of patience, and it's probably not suitable for the majority of you watching. However, some of you have really requested me to make a lecture on this topic, and that is also where the inspiration for the swing trading series comes from, because swing trading can be applied to all time frames, meaning you can be looking at intra-week trading, you can be looking at, for example, just your regular quarterly trading, or you can look at, for example, holding on to positions for years and really build big investment portfolios and such, utilizing the theories as I'm explaining them to you and you giving them your own touch and such. At the end of the day, you need to pick what you are most comfortable with and what suits your approach to markets. So I want to wish you good luck within your studies and look forward to catching up with you in the next one. Be safe. Hello there. I hope that you are doing well. Welcome to the third episode of the swing trading series here for the 2025 mentorship. I hope that you watched the first two episodes before watching this episode. I understand that some of you will go backwards through this series and you will begin at the end and go back all the way to the beginning, but I truly suggest you to begin this series from episode 1 and move onward from there. The reason why is because I'm sharing everything during this lecture to someone who has already watched through those first two episodes, so please do so. Navigating the weekly delivery. Each week requires a different approach as swing traders. This has to do with the difference when it comes to each weekly economic calendar. Meaning, we use the economic calendar as our roadmap. Based upon the economic calendar, we can anticipate when and where volatility will get injected into the markets. As swing traders, our job is to capitalize on these volatility injections, which cause the markets to expand. Understanding weekly delivery profiles is therefore crucial. Before you are watching this swing trading series, I already suggested you to begin with the predicting price series, and I'm going to suggest that again. If you did not watch the weekly profiles episode yet within the 2024 mentorship playlist, I would highly suggest you to watch the second episode of that predicting price series on weekly profiles. In that episode, I share everything you need to know when it comes to understanding how to use the economic calendar properly. During this episode, I will expand on the knowledge provided. General rules when it comes to navigating the weekly delivery. Your focus should be on recognizing the higher time frame institutional order flow by paying attention to the reactions to previous week's high or previous week's low and the previous month's high and previous week's low. These are our most important time-based liquidity pools, which we can monitor the reactions of to see how icttrading is currently delivering price. If the higher time frame order flow is clear, we can enter swing positions early in the week in advance of the high impact news scheduled for that week. If the higher time frame order flow is however not clear, we need to wait for the high impact news to deliver before holding on to one-sided biases for the week to come. Why would we have to wait for that high impact news to deliver before we can hold on to a one-sided bias if the order flow is not clear? Because the news is likely going to manipulate then, and what always follows after manipulation? After manipulation, distribution will always follow, and the news will function as a volatility injection so that manipulation can occur so that we can then distribute our positions afterwards. Now notice that these are if this, then that statements. And that is something which is very important to understand, since this is how we are objectifying our approach to the markets. Where the majority of traders are reacting to price, we are absolutely anticipating how the markets will deliver. And that's the result of us utilizing these if this, then that statements. If the higher time frame institutional order flow is clear, we can look to enter in advance of news. If it isn't clear, wait for the news. That right there is part of the navigation of the weekly profile. And even if you're not a swing trader, this is a rule which should be applied to your own protocol when it comes to navigating higher time frame institutional order flow. Implementing time as swing traders. Use the economic calendar to anticipate when key price swings will occur. Meaning, based upon the economic calendar, we can anticipate when major volatility injections will take place. If the higher time frame institutional order flow is already in and we can see what the markets are likely going to do next, news is likely going to get utilized for the markets to draw towards our objectives. Meaning, news will be utilized as an expansion tool. Use the London and New York AM session to look for setups. Meaning, the majority of the setups which we are going to look for as swing traders that are focused on capturing intra-week volatility, we are focused on participating in the markets during either the London or the New York morning session. And that has to do with the fact that we can utilize the midnight opening price as a key reference point throughout the daily delivery. Sorts of high impact news. Regular high impact news are the following. Any high impact news driver besides NFP, CPI, FOMC or other big worldwide events is considered as regular high impact news to me. Next to that, we have the big three. The big three consists of NFP, CPI and FOMC. These are the two classifications of high impact news that I look for. And these two classifications of high impact news require different protocols. And let me explain. Navigating all weeks when there's clear order flow has the same protocol. And that is when the new week opens up, our focus is drawn to the delivery between the new week open and the high impact news, which is already scheduled in advance. The eye therefore represents where we are looking to position ourselves. Our eye is open for opportunities, so to say. This is the framework which applies to navigating all weeks. So both the regular high impact news weeks as the big three weeks. But keep in mind that this is only allowed when there's clear higher time frame institutional order flow. If the higher time frame institutional order flow is clear, focus on the days in advance of the high impact news. News will distribute. Keep in mind if the higher time frame institutional order flow is clear. Navigating regular weeks with no clear order flow. A regular week is again a week outside of the big three or any other big worldwide events. And therefore, when there's no clear order flow present in advance of this high impact news, we must anticipate that opportunities will present themselves after the high impact news. Therefore, you can see in this schematic that we have the new week open right here. We have the high impact news showcased by this red line right here. And we have the end of the week. Our focus is on monitoring how the high impact news will get utilized to inject volatility into the markets so that opportunities can present themselves after the high impact news before the end of the week. Do you notice the difference? This is a result of the higher time frame institutional order flow not being clear. So as a general rule of thumb, if the higher time frame institutional order flow is not clear, focus on days after the high impact news drivers. This is a keynote for your protocols because this shows you how to navigate the weekly profiles properly. Navigating the big three, NFP. When there's clear order flow present during an NFP week, our focus is on the following. Notice that NFP is always on Friday of this week. Therefore, you can see that it's right here near the end of this week. Our focus is on the following. Our focus is on the time between the new week open and the Wednesday's afternoon session. Meaning we will be looking to position ourselves in advance of Wednesday's afternoon session. That means that our focus is on Monday until the end of Wednesday's morning session. If by Wednesday's end of morning session, no opportunity has presented itself yet to participate in the weekly delivery as swing traders, we must wait until after NFP. Because NFP is likely going to inject major volatility then. If, however, clear order flow is already present from the moment that we open up the new week, we can look to establish a position in advance of the end of Wednesday's morning session, and then we can look to capitalize on the volatility which is likely going to follow throughout the remainder of the week with the NFP release. We're now going to be looking at navigating the big three and specifically CPI and FOMC. But keep in mind that now there's no clear order flow. Because there is no clear order flow established in advance of CPI and FOMC, we must wait until after the release of the event. And please note that I'm speaking about either CPI or FOMC. It can also be both, of course, but in this case, I'm speaking about either. Meaning it can either be CPI right here or it can be FOMC. Our focus is on after the event to look for positions to be established. This is a result of there no clear order flow being in place just yet. And therefore we need to wait for after the event before you can say, all right, this is what's likely going to happen next. Because the news release is likely going to be utilized for a major volatility injection, which is going to cause for distribution to follow afterwards. Let us pay attention to some chart examples. Here we're on the daily chart of Nasdaq. And what I want you to see is that Nasdaq expanded higher beautifully here. And you can see that the beautiful buy program was established. I'm going to walk you through this delivery. And I want you to pay attention to each of the annotations which I have. First of all, I want you to see this down close candle right here. The open of this down close candle was the open of the year of 23. Next to that, it was the open of the month of January. From the opening, you can see that the market dropped lower and took out sales at liquidity resting below this low. Why is this low important? Because it is the previous month's low. It's the low of December. Notice that the market took out this low and then expanded higher. Notice that an imbalance formed whilst the market traded above this yearly and monthly open. We can see that the market retraced into that BC, into that imbalance. We then saw the market expand higher. Inside of the retracement into this imbalance, there's already an opportunity to go long. And that's a result of IPTA already showing its hand to you by this displacement higher. If you would be focused on establishing positions that would last multiple weeks or even months, this would be a potential entry opportunity. But that is something which we'll discuss during the next episode of this swing trading series. What we can see is that the market expands higher and we see it trade above this retracement on the left side of the curve. As outlined prior, when the market trades above a previous range, which functioned as a retracement range, as you can see here, where we saw the market expand lower, retrace higher, expand lower. When we see the market expand above the high of that retracement range, we want to see it function as support on price. Notice that the retracement occurs inside that range multiple times and the market expands away from it. Another retracement occurs and we then see the market displace higher and this imbalance forms right here. Notice how the market retraces into that imbalance and we again see it just step into it before expanding higher. What is the market drawn towards? The market is drawn towards buy side liquidity resting above this high. Why specifically this high, you might be wondering? Because this high was the high of December. Meaning, what we anticipate is that price is going from the previous month's low to the previous month's high. That's a purge and revert of a monthly low towards a monthly high. When we pay attention to Nasdaq and the yes then, I want you to investigate the delivery on the lows right here on both Nasdaq and CS. I want you to pause this lecture for a moment and I want you to try and see whether or not you can see anything of significance right here. Some of you never pause these episodes. It's pretty fun. You're missing out on this learning opportunity, guys. Don't waste it. So what I want you to see is the following. What I want you to see is that Nasdaq took out that December low, as you can see right here. A lower low formed. If you, however, pay attention to ES, you'll see that ES made higher lows. And that right there is SMT relative to a monthly low. And when you combine that with the understanding that we just opened up a new year and we initially dropped lower, that right there is a key algorithmic signature. We see the market displace higher above that opening price, and that right there is IPTA tipping its hand to you. Now, you might be wondering, how could we possibly use this information of the market being bullish and it being drawn towards the upside? Well, if you remember that slide in which I showcased to you where the market had those daily imbalances, we are now on the RE chart and I've plotted those daily imbalances, these blue shaded box, and I'm going to walk you through the delivery that has taken place from that blue box. What I want you to see is that you can see that the market consolidated right here. Notice that relatively equal lows formed. This right here is the original consolidation within a market maker sell model. The market expands towards the upside and we see it consolidate once more. Eventually the market runs the previous day high, the Monday high, and we see the market reject that high. A sudden drop lower takes place and notice that this CB gets created. We see a retracement into that CB occur and the market is now drawn towards these relatively equal lows. But please keep in mind that the sell program is only going to last until that higher time frame discount array gets reached of that daily BC. We see the market expand lower and throughout the New York morning session, listen closely, throughout the New York morning session, this daily BC gets reached. These relatively equal lows get purged and we see the market form a low there at exactly 10 a.m. right here. We see the market reverse from there and we begin to see the market draw towards the upside. Notice that when this repricing higher is taking place, we can see that the market displaces above this sequence of down close candles. This is very important to understand. The reason why is because this sequence of down close candles set up the run into the daily imbalance, into these relative equal lows, and what is resting below these relative equal lows? Sell side liquidity. And what's occurring is that smart money is being offered the opportunity to buy in a discount, utilizing all of those sell orders which are resting below these relative equal lows to fill long orders so that the market is then allowed to expand higher. The moment that price traded above the open of this sequence of down close candles, it's a change in the state of delivery. And this is already a potential buying opportunity. Is it possible to go long inside the smart money reversal? Yes, it would be possible to go long inside the smart money reversal with a wide enough stop loss, which would allow for the market to trade deeper into the daily imbalance. But that's a topic for another time, because then the position which we would be looking to establish would be more of a, I would say, longer term position. Then we would try to hold on to that position for weeks or maybe even months, since that is a higher time frame swing which is being established. As a intra-week trader, this would be the first entry opportunity in my opinion when the market trades above the sequence of down close candles, because this is your change in the state of delivery, and now we can logically anticipate that we're likely going to see the market draw towards buy side liquidity resting above this high, and next to that, buy side liquidity resting above this high right here, which is of course that December high. Now notice when the market reprices above that CB which formed on Tuesday, you can see that that CB functions as support on price. This right here is an inversion for value gap. Pay attention to this retracement leg on the sell side of the curve. That retracement leg has to function as support on price, as you know. We see the market expand above the Tuesday high and we see a retracement taking place afterwards. Notice that new buy side liquidity is being engineered and the market eventually retraces before continuing higher. Every single time that price is taking out a key buy side liquidity pool, as you can see right here, and it then retraces, it's engineering new buy side liquidity. And that's the same fractal which you're seeing right here. And this is key information which you need to understand. This is how the markets are being utilized to engineer liquidity, which we can later use to our own purpose, as you know. Now, when we pay attention to what occurs right here, you can see that the market stops right in advance of that December high right here on the end of the week on Friday. That right there is very suspicious, and let me explain. If we are ending the week right in advance of a higher time frame drawing liquidity, what does that mean for the week to come? That we are likely going to see the new week open low. Listen closely, teaching opening logic to you. That we're likely going to see the market open low and begin to draw towards the buy side liquidity engineered above the previous week's high and that longer term buy side liquidity objective of that December high. When we pay attention to the delivery which occurred, you can see that the previous week's high was engineered in advance of the higher time frame drawing liquidity of the December high. This is very important to know because this shows you how liquidity is constantly being engineered and how true manipulation is taking place. We see the market expand towards the downside, and this is the sell side of the curve which is being established. Notice what the market is being repriced back into. It's being repriced back into that old CB's price range, as you can see right here. Notice that we see the market tap into that CB's range, into that inversion value gaps range, form a low there, and then begin to displace higher. We displace above this opco candle. Why is this opco candle in particular so important? Because this opco candle formed inside of this CB right here, as you can see. And next to that, this high set up the final run lower into that old inversion value gap. Therefore, you need to understand that the moment the price closes so aggressively above that opco candle, this is a bullish breaker. Why? Because we see a low, high, lower low, high, high. During this week, we had FOMC and NFP on Friday. Therefore, as outlined prior, when the higher time from institutional order flow is so clear to us, and we anticipate that we're likely going to see the market expand higher, we can look to position ourselves long in advance of all of that high impact news early on in the week, because we can anticipate that the news is likely going to get used to distribute. We see the market retrace into this opco candle, and this is your low risk buy within a market maker buy model, with our original consolidation being up here, with the previous week's high being the drawing liquidity. Breakaway gap gets created and the market expands higher. On Wednesday, FOMC release is scheduled, and there's a lot of high impact news during the morning session, such as the JOLTS job openings, which is also a high impact news driver, as you know, which is very important to note. Consolidation is occurring, and eventually what we can see is that the market opens low during the afternoon session at 2 p.m. when the FOMC release begins, and we see the market expand higher, beautifully towards our drawing liquidity, and that's the delivery done. Guys, do you see the power of understanding when news is likely going to take place, what the drawing liquidity is, because you can literally anticipate when they're going to reprice towards that drawing liquidity. How beautiful is that to understand? Now, let us move on to the next example. The next example which we're going to discuss is a swing trading opportunity on both Euro, SGU, as you can see right here. On the left, you can see the Euro daily chart, and on the right, you can see the GU daily chart. Now, what I want you to see first of all is the following. What I want you to see is that from the yearly open on Euro, we saw the market initially run up higher, form this swing high, and then we saw the market displace lower. Notice how a CB forms through the yearly open. Remember what I outlined on the daily chart of Nasdaq and ES. We see the market eventually expand lower, and it then begins to retrace. Notice that we retrace above the open of the month of February, which is right here, and we retrace back into this daily CB right here. Now, the reason why this is so important to note is due to the following. Whilst Euro is making lower highs, at the same time, you can see that GU is making higher highs this whole time. I have annotated exactly the same time-based high, which you can see right here, and you can clearly see that on GU, higher highs are being made, whilst on Euro, lower highs are being made. This by itself is SMT, and it shows to you that when a second SMT is going to take place, we are likely going to form a swing high from a key level so that we can anticipate lower repricings to take place soon. What is the key level that we're monitoring? Yearly open right here, and this CB. Notice that Euro makes a higher high with this long wick, whilst GU makes a lower high right here. That right there is SMT between these daily candles. We see the market displace lower, and we see a CB form. Through what does this CB form? Through the February open. And guys, start paying attention to opening prices and erase that form around them. That's something which you need to take away from this episode, even if you're not a swing trader, because the same logic applies to lower time frame trading as well. Notice that there's very large CB forms right here, and we see the market retrace into that. Eye of that, institutional order flow entry drill is taking place from this CB, and the market expands lower, drawing towards sell side liquidity resting below this low, the low which set up the retracement, and sell side liquidity resting below this low. Now, what we will do is we will pay attention to the delivery inside of this CB. So what I just outlined to you is how from the daily chart you can tell that the order flow is bearish, where you can see that premium rates are functioning as resistance on price, and there's SMT with a highly correlated market. Now we have a hard time from array right here of a daily CB, which displays through the February open, after we saw multiple SMTs confirming that the underlying order flow is in fact bearish. Here on the hourly chart of Euro. And what I want you to see is the following. What I want you to see is that this candle's high is the low of that daily CB. Notice that the market consolidated right here. We then saw it expand lower on Monday. The function of this expansion lower on Monday is to trap retail-minded traders into thinking and believing that we have already formed a high of week and that Euro is very bearish. They will look to go short throughout this expansion lower and place their stop losses above these highs right here. We see then on Tuesday that the market initially drops lower from the midnight open right here. We see the market then expand higher. Notice how a BC forms right here. Midnight open, BC. Little jump for you in there. Market retraces into that BC, institutional order flow entry drill, and we see an expansion higher taking place. Now, here comes something which I absolutely love to see. And that is that the market stops right in advance of that daily CB, that blue shaded box. Notice how the market begins to consolidate. Again, what is occurring here? Liquidity is being engineered in advance of that point of interest, in advance of that higher time frame array. Now, what we're looking for is the market to open high into that at the right time so that we can anticipate that we're likely going to see a reversal taking place. What I want you to see is that inside of this week, on Friday, we have the NFP release. We are now on Wednesday. When is the final time that we can look to enter our positions? By the end of Wednesday's morning session. And therefore, this is still within our time of interest for this week. Notice that the market forms a swing high inside of that daily CB. We see the market displays lower. We displace with a CB through the weekly open right here on the hourly chart. We displace below this candle's low. Why is this candle's low important? Because this candle's low formed inside of this BC right here. And you can see that this low set up the final run higher, taking out buy-side liquidity resting above this high. You see the market retrace into that candle's low, and this is where we would look to go short. We are shorting above the weekly open, as you can see, inside of a premium array of that CB, inside of a bearish breaker, inside of a market structure shift pattern low, and we know that the higher time from institutional order flow is bearish, with NFP being on Friday. How many confirmations do we need? How many confirmations do you need that this is the low risk sell within this market maker sell model fractal, with this being the buy side of the curve and this being the sell side of the curve? Accumulation, manipulation, distribution. On Thursday, the market begins to slowly grind towards the downside before the real expansion lower begins, which continues on Friday, where the market is just drawn towards higher time frame sell side liquidity pool objectives. With that, this third episode of the swing trading series comes to an end. I hope that this episode and the previous episode has given you a good insight in how to navigate the markets as an intra-week trader, where we look to capitalize on weekly volatility. During the next episode, I will teach you how to look at more longer-term trading moves, where you can look for entries that will last for multiple weeks or maybe even months. This is, of course, a larger swing trading perspective. I want to wish you all the best, and I kindly suggest you and recommend you to investigate all of these signatures which I've taught to you. I look forward to speaking to you in the next episode. Be safe. Hello there. I hope that you're doing well. Welcome to the fourth episode of the swing trading series. During this episode, we will be discussing long-term trading. And you might be thinking to yourself, what exactly is long-term trading? Because this whole series is about swing trading, right? Yes, that's true. However, there are different ways of swing trading. You can be an intra-week trader, or you can hold positions for more than a few months. And that is what we will be discussing during today's episode. Long-term trading. To me, long-term trading is the following. Positions that last longer than at least 1 month are considered to be long-term trades in my opinion. This is applicable to each asset category, meaning as long as you're able to frame the right narrative and you're able to see what the higher time frame institutional order flow is, opportunities will present themselves in each asset category. That means that these opportunities present themselves in the index futures, in the forex markets, in the commodity markets, and even in the crypto markets. This long-term trading strategy is suitable for traders with a lot of patience. That means that you need to be able to sit in positions for a very long time. This type of trading is great for those of you that have full-time jobs or are very busy in your personal life and do not want to spend a lot of time behind the charts. However, this is also applicable for those of you that are day traders but are ready to next that also have other portfolios for swing trading. Portfolios that are based around you holding onto positions for longer periods of times, such as in stocks or in other asset categories that you are interested in. Pay attention to major narratives being in play. That means that you need to be able to recognize very important larger narratives which are being established in order for these major price swings to occur. Because when you're able to recognize what the narrative is, you can anticipate that they're going to utilize that narrative to reprice heavily on the markets that you're looking at to trade them. Time frame alignment. When it comes to time frame alignment, I suggest you to pay attention to the monthly, weekly, and daily charts. The higher time frame analysis should be made on the monthly and weekly charts, and the execution should be done on the weekly and daily charts. If you go lower than this, the chances are high that you're likely going to be trading intra-week or intra-month swings. However, since we are focused on very long-term positions, we are focused on executing from that daily chart as mentioned. Now let us take a look at an example of Tesla. What you can see is that the Tesla stock has risen towards new all-time highs recently. Notice that it took a while for the market to get going after it formed the low right here and it began the buy side of the curve. I need you to see that this is the sell side of the curve followed by the buy side of the curve. And we are going to specifically pay attention to this repricing higher which took place throughout the end of 2024. As many of you know, in the United States of America, throughout the month of November, a new president was elected. This president was President Trump. Notice that this news was utilized to reprice Tesla significantly towards the upside, paired with a lot of other stocks within the Nasdaq 100. Now, when it comes to this news event, you need to understand that they were literally holding the majority of the stocks inside of tight ranges, so that when the news would come out that President Trump would get elected, you would see this repricing higher taking place. So what is occurring here is that the market is being held inside of a tight range, the news comes out, and then that news gets utilized as a smokescreen to reprice towards the upside, to reprice Tesla towards the buy side liquidity engineered above this high. Notice that when this high was taken out, it was taken out with this very long wick right here. Now, what we will do is we will investigate the delivery that took place, where I can see that the sell side of the curve occurred, followed by the buy side of the curve. What I want you to see is that I've annotated the 2024 open right here. And from the 2024 open, you can see that Tesla immediately dropped towards the downside. You can see that the market immediately repriced lower. Why is this important? Because what is happening here is that for the yearly candle, the 2024 candle, the market is open low. And that right there shows to you that smart money is buying below that opening price. They are positioning themselves long on Tesla. Notice that the market begins to trade above the 2024 open right here, but initially rejects it. We see it retrace into the monthly BC, which got established right here, and we see the market expand above the 2024 open. Notice that the 2024 US elections took place and the market was immediately repriced towards the upside. It was in a rush to run higher. Why? Because that news was the perfect smokescreen for stocks such as Tesla to reach new all-time highs. When we pay attention to the weekly chart then, what you can see is that when we open up for 2024, the market initially ran lower as outlined on that monthly chart as well. Notice that the market ran lower towards this old weekly BC right here. Inside of this weekly BC, we saw the market form a new low after taking out sell-side liquidity, which was engineered inside of that weekly BC. We saw the market consolidate for a while, and we then saw these two imbalances get created right here. Notice that these two imbalances got created the moment that the market repriced above the 2024 open. A retracement occurs, and notice that the market is again consolidating. It's waiting. What is it waiting for? It's waiting for that smoke screen to come out. The smoke screen of the USA elections. And therefore, what you're beginning to see and beginning to understand is that smart money is using that period in advance of the elections to accumulate positions. What you need to understand is that in advance of that smoke screen, which is already scheduled months and years in advance, they're utilizing that smoke screen, which they know will come out, to position themselves long on Tesla. And you see that through this. You see that by them respecting these discount arrays over and over again, so that the moment that price displaces above the 2024 open and the US elections are here, you can see that the market opened low for this week and immediately repriced towards the upside, because this was one big market maker buy model with an original consolidation down here, smart money reversal, buy side of the curve. So when it comes to finding these long-term plays, what you need to recognize and need to anticipate is when specific high-impact news drivers will take place. And we're not speaking about a high-impact news driver such as a, let's say, CPR release or an NFP release, as you know it from the intra-week trading, of course. We're speaking about major events, such as a new US president coming into office, or such as a war breaking out, or such as certain financial changes within the banking system taking place. When you can recognize that these certain narratives are going to get ran with, you are able to anticipate major price swings to occur. And when you can anticipate that these price swings will occur, you can play in on that. And that is what I need you to understand when it comes to finding these long-term plays. This is a beautiful example of a buy program, and this is also why we were so bullish on the indices the moment that President Trump in fact got into office. Because from that moment in time, we were looking for one thing, and that was longs, 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 until proof otherwise. Because stocks such as Tesla, which are very important, were all showing the bullish signatures which we're looking for. And that confirmed to us that the Nasdaq 100 would likely be repriced towards the upside even more. Now, when it comes to the daily chart then, what you can see on this daily chart is that when the US elections took place and the result came out that President Trump would in fact become president again, what you can see is that the market expanded higher. Notice that it displaced through the 300 price level with this imbalance right here. Notice that this imbalance has to function as support on price in order for the underlying order flow to remain bullish. So that means if you did not position yourself long yet in this area in advance of the US elections, what you could have waited for is for the retracement into that daily imbalance, and then you could have looked for longing opportunities in this area. We then saw the market eventually expand higher and it dropped towards that old autumn high. That is, of course, a price where a lot of buy-side liquidity was engineered above. When we pay attention to another example then of a long-term trade, we are going to be paying attention to the weekly chart of the dollar. What I want you to see is that the dollar was consolidating throughout the beginning 2 quarters of 2023, where you can see that the market was just going back and forth, back and forth, back and forth, and it was in a very slow downtrend. Notice, however, that when we saw the market drop lower with these 2 big weekly candles, we saw the market quickly turn around, and you can see that there were so many green weeks in a row where the dollar was just in a rush to do one thing, and that was run higher. Why, oh why is this so important? Because I need you to understand that what was taking place was the following: accumulation, manipulation, distribution. And that is the factor what you're seeing here. Or in other words, what you're seeing is that buy-side liquidity was engineered above this high, sell-side liquidity engineered below these relatively equal lows. We take out the lows, we refer to the high. It's that straightforward, guys. Now, when we pay attention to this narrative then, you need to understand that throughout this repricing lower, every single retail minded trader is thinking to themselves, okay, the door is weak. It's just going to continue dropping. And these final two big down close candles confirm that to them. However, you need to view these big two down close candles as the following. You need to view that as manipulation taking place, so that after manipulation, distribution can follow. Inside of these big two down close candles, you need to understand that there's this final push of the narrative of the door is weak. It's going to come crashing down. The door is going to fail and this and that. And that's the news which is going to get thrown around, right? Where you can see the media say, oh, the door is so weak. This is the end of the door. It's going to roll over and the door is going to come crashing down and this and that, right? And that's the type of narrative which would then get utilized. However, I need you to understand that when the media begins saying these things, right, you should immediately think to yourself, but hold up, wait a minute. Who's actually in control of the media? Who's actually in ownership of the media? Who decides what gets attention on social media platforms? Who decides what news comes out and what news doesn't come out? Who decides what news gets attention and what news doesn't get attention? And I don't want to get into a whole rabbit hole right here and speak about conspiracy theories, right? Because that is simply not like the reason why you're watching this episode. However, I want you to start thinking about these things, right? I want you to start thinking about why is it always the case that in advance of key market reversals, it's like the media is just throwing around all of this positive or very negative news to trap every single normal person, average Joe, into believing the wrong thing. And when you can recognize that, and when you can recognize that your technical analysis was already telling to you that when these big two down close candles were forming and the market was dropping lower significantly and the bearish news comes out, when you recognize that, man, it's the perfect confluence to anticipate a smart money reversal forming. What you can see here is that I've annotated the chart and I've annotated these two highs right here to be key buy side liquidity pools. And next to that, you can see that I've annotated these quarterly lows right here. Below these relatively equal lows, a lot of sell side liquidity has been engineered. How do I know a lot of sell side liquidity is engineered below these relatively equal lows? Due to the amount of time it took to form these relatively equal lows. It took 2 quarters in order to form these relatively equal lows. So every single retail mind trader is looking at that as a strong support level for the year of 2023. However, what occurs? Notice that we saw the market drop lower significantly right here, take out these two relatively equal lows, and we then saw a smart money reversal taking place before the market expanded higher. However, there's something which is very important when it comes to these two down close candles. Because what you can see here is that these two down close candles, yes, they began the moment that the third quarter opened up. And that should be a big light bulb. Because for those of you that understand, as I've taught you, time cycles, you will be able to see the following. You will be able to see that the market opened low for this third quarter, took out previous quarterly lows, so those are previous cycle lows, and from there on you begin to see the signs that confirm to you that a reversal is taking place. What is the market drawn towards? It is drawn towards buy side liquidity engineered on the opposing side of the range, and that is right here, because who is making money all throughout this drop lower? Sellers, of course, and those sellers, they seem to believe that it's just going to continue dropping, right? That at one moment in time it's going to turn. And when you begin to recognize the signs that the underlying order flow is in fact turning, that is when you need to be wary of the fact that that is likely going to be the case soon when the time is right. Now let us take a look at this line right here. This line right here represents the 2023 open. And what you can see is that the market was trading below the 2023 open and below the Q3 open and below the previous cycle lows. And that is why this was a high probability SMR, where price is trading below key opening times, which suggests to you, yes, the following. It suggests to you that the market is in a deep discount. And when it is in a deep discount, you can anticipate that at one point in time, the underlying order flow is likely going to change from bearish to bullish. And when it does, that is when we can anticipate that we're likely going to see buy-side delivery next. And that is what we were waiting for. And when the signs were present to us that we were in fact turning here, that is when we looked to go long on the door and short on Euro and GU. Here on the daily chart of the door. And what you can see is that when we opened up for Q3, the third quarter, we in fact saw the market displace towards the downside and it quickly began running over. Notice that we spent some time below the relative weak lows of those quarterly lows right here. And we then saw the market eventually turn around. And we saw it begin displacing higher. Notice that this BC right here formed whilst the market repriced above the price level of those relative weak lows. Why oh why is this important? Because it tells you that this is a crucial imbalance to monitor, whilst the market is also repricing above the first few imbalances near the SMR, which should have functioned as resistance on price if the underlying order flow would remain bearish, right? That is what I've taught to you within the 2024 model series, within the order flow lectures. We see the market retrace into that BC and it finds support there. Notice that we then see an expansion higher taking place. And from this moment in time, you should immediately think to yourself, all right, who has been making money for all these months now? Short sellers. And therefore, we can anticipate that when the time is right, that we are likely going to draw towards all of the buy-side liquidity resting above these highs right here in the form of trendline liquidity and clean highs, of course. We see the market expand higher and it trades above the Q3 open. Next that you can see that we see the market trade above the opening of 2023 and we see the market trade above this high right here. Now, why in particular is this high so important? Because this high was the high of this retracement on the sell side of the curve, where you can see that the market expanded lower, formed this low, retraced, and then had its final push towards the downside. Now, this has to do with market maker model symmetry, which I'm going to teach to you. When you know that the market is drawn towards buy-side liquidity resting above this high, or for example this high, yes, we can utilize any retracement on the left side of the curve, such as here, this retracement higher, as a range to monitor once the market trades above it. So we can anticipate that this range is going to function as support on price once traded above on the right side of the curve, when we know that the time is right for that buy program to unfold. And that is why it's so important to recognize the smart money reversal right here. When you can recognize the smart money reversal, and you know that this is point A of the buy program, you can anticipate that the market is not going to stop expanding higher until it completes its market maker buy model, until it reaches point B. We see the market retrace into that old retracement leg on the left side of the curve, and notice that it trades back into the Q3 open. The market finds support here, and we see it expand towards the upside, and we see the market take out the buy side liquidity resting above this high. Notice that during this expansion leg higher, an imbalance formed right here. And now this imbalance has to function as support on price in order for the underlying order flow to remain bullish. Why? Because this imbalance formed throughout the expansion leg into this buy side liquidity pool objective. We see the market eventually retrace into that imbalance and it expands higher once more. Notice that another imbalance forms right here, a tiny one. The market retraces into that imbalance and into this old high before expanding towards the upside quickly, drawing towards the buy side liquidity resting above this high and creating a new yearly high. This is the market maker buy model done on the door. Now you might be wondering, where can we look for buying opportunities on the door? Well, the first opportunities present itself all the way in this area, below those quarterly lows, of course, inside of that SMR. Next, that buying opportunities presented itself in every retracement towards the downside which occurred. For example, here, or here, or here, or here, or here, until the draw on liquidity of this high was met. The moment that draw on liquidity got hit, yes, from that moment in time, you need to let go of the idea of the following. You need to let go of the idea of simply just, okay, we're not going to continue higher anymore. Just let go. And when that is the case, be content. And if you missed out on the move, you missed out on the move. And you need to wait a few more months before the underlying order flow becomes clear again for such a mega move to take place. Notice that this move originated from the 100 price level, the door. Now, when we pay attention to intermarket relationship then, inside that smart money reversal, what I want you to see is that on the left you can see the dollar and on the right you can see the euro. Notice that the dollar created a higher low below those quarterly lows right here, whilst euro created a higher high right here. And that right there is a correct correlation, because that signals to you that a smart money reversal is in the making. Because what is taking place is that SMT is forming here, where the dollar should have made a lower low, whilst euro made its higher high. And it didn't happen. So that shows to you that the sell side of the curve is coming to an end and that the buy side of the curve is going to take place soon. The time is right for the market to begin to expand higher soon. And that is what you see, of course, on euro be utilized for that repricing lower. Now, let us pay attention to the euro chart then, because here we're on the weekly chart of the euro, and what you can see on this weekly chart of euro is the following. You can see that I've annotated the 2023 open, I've annotated the Q3 open, and next to that you can see that I've annotated sell side liquidity resting below this low and buy side liquidity resting above this high. Notice that when we open up this third quarter, we saw the market immediately open up and run up higher quickly. Notice that the market took out buy side liquidity resting above this high, and we saw the market eventually form a smart money reversal here before displacing through the imbalance which formed during this final leg higher. Notice that a weekly CB formed right here, and the moment that euro retraced into that weekly CB, whilst the dollar was showcasing to you that it was likely going to change from sell program to buy program as well on the higher time frames, this was already a first shorting opportunity right here. Why? Because we displaced through the buy side liquidity pool, or through this old high, I should say. We displaced through this imbalance, which should have functioned as support and price if the underlying order flow would remain bullish. We saw a bearish array get formed, and we saw the signs that confirmed to us that the SMR was in play, and we're trading above the Q3 open, which opened high, and we're trading above the 2023 open. So what do you know? You know that we're of course in a very deep premium for euro, whilst the dollar is in a very deep discount. So the dollar is likely going to turn around for the remainder of the year, whilst the euro is also turning around for the remainder of the year. And that right there is absolutely beautiful to understand, because that is how we can utilize intermarket relationship. Now, when we pay attention to the repricing which took place afterwards, you can see that euro had a very bearish remainder of the year, where you can see that there were many weeks in a row where the market was just expanding towards the downside. Now, when we pay attention to the daily chart then, what you can see is that I've annotated that weekly CB, and next to that I've annotated some different arrays as well. What I want you to see is that when we opened up for this third quarter, we saw the market expand towards the upside quickly and multiple imbalances were created. We saw the market expand heavily above the buy side liquidity pool of these relative vehicle highs, and this was a market maker buy model which was being completed. Original consolidation, sell side of the curve, buy side of the curve. We saw the market expand above those relative vehicle highs, and we eventually saw the signs of a smart money reversal forming in this area, where you can see that SMT took place and the market began violating the imbalances which formed on the left side of the curve right here. Now, this is where a lot of pattern traders get mixed up, because a lot of people, right, they seem to believe that whenever an imbalance gets created, that imbalance has to function as support and price, because then the market is just going to expand higher, right? They think that you should go long right here. Breakout artists would love this, right? They see this as, oh, euro is very strong and the dollar is very bearish. However, here comes the thing, guys. You need to understand that an imbalance can also show to you manipulation. So what you're seeing is you're seeing this very quick expansion higher, and you're seeing these imbalances get created. But these are not imbalances, yes, that we can utilize to continue looking for buying opportunities. Instead, we are going to utilize these imbalances as inversions for value gaps on the right side of the curve, which is likely going to take place soon. What you see is that the market displaces through this highest imbalance right here, and a CB forms. A retracement takes place into this CB, and this is where institutional order flow entry drill is taking place, where I can see that the market is just stepping into the CB right here. The wicks go in it, but notice how quickly the market is rejecting it. That right there shows to you that there's an urgency for the market to expand towards the downside. the weekly CB gets created, and you can see that the market retraces into that, and we then see an expansion leg lower occurring. Notice that the market now displaced through the Q3 open and through an imbalance which formed right here on the daily chart. Notice that this imbalance now has to function as an inversion of the value gap in order for the order flow to remain bearish. Notice that the market taps that imbalance multiple times, and this is where intra-week traders should smile, because they should know by having watched the previous episodes. If you didn't watch the previous episodes yet, you shouldn't be watching this lecture, guys, by the way. Like, I honestly don't understand why people go from the end of a series to the beginning of the series. In my opinion, it's stupid, right? Like, just follow along with the structure that I'm releasing everything in, because I'm slowly and gradually increasing the level of difficulty. The same as I'm going to do within the 2025 model series, where I'm going to simply begin at a certain foundation, or begin establishing a foundation, and then on top of that foundation, I will build and build and build. Why do you think I began with just the intra-week trading when it comes to swing trading? Because in general terms, that's usually the easiest form of swing trading. However, we're now looking at very long-term plays. And by the end of this lecture series, you will receive schematics which you can utilize in order to find these big swing setups. And that is going to be the final lecture of this series, but that's for then. Anyhow, an intra-week trader would utilize this daily BC as an inversion value gap as his point of interest to look for smart money reversals within market maker sell model fractals. Because when he recognizes smart money reversals occurring within market maker sell model fractals around that Q3 open and around that daily BC, he can look for lower time frame opportunities to present themselves. Notice that the market eventually expands towards the downside and expands below this down close candle. The moment that the market traded below this down close candle had to function as resistance on price, because this down close candle, yes, was the low of Q2. Yep. And that should be a very big light bulb for many of you. That's a quarterly low which got traded through and should now function as resistance on price in order for the underlying order flow to remain bearish. And next to that, you should understand that this down close candle is a bearish breaker, where I see a high, low, higher, lower low. Market retraces towards the high of the down close candle, just wicks above it, but notice that the bodies keep on closing below 50% of that range and below the 2023 open. That right there shows you that the market is likely going to expand lower soon. Is it possible to enter this rate when the drawing liquidity is this price level? It's possible. However, the higher we can look to short, the more ideal the position is, of course, because the more in the premium we short, the more room there is for potential profit. Is this a pyramid opportunity? Yes, absolutely. So with that being said, I want to thank you for watching this 4th episode all the way to the end. I hope that this episode has given you some insight on how to anticipate these very large price swings utilizing scheduled news events next to sound logic of understanding, all right, what is the year doing so far? What are the opening prices telling to us? And what is IPTA doing in general? Is it creating the narrative that we're very bullish or bearish? Because when we have that narrative established that the masses are adhering to, we can look to do the opposing. And that right there is a mindset that you need to be able to adopt, where the majority of people would choose to go to the left, you would have to choose to go to the right, because that is manipulation which we can recognize, so that we can look for the distribution to unfold. We don't look to participate where the dumb money is participating. Well, we actually do, but we do the opposing of what they're doing, right? We're trying to align ourselves with the smart money. We trade as smart money does. And that is the perspective which I'm teaching you throughout my mentorship. So I want to thank you for watching this episode all the way to the end. If you want to investigate what I've shared with you, I suggest you to go to the weekly and monthly charts of the markets that you're interested in, whatever asset class you choose to use. Investigate these very major reversals that occurred, and then research the news which was taking place around those reversals, and you will begin to see the alignment with those big narratives and, of course, the technical analysis. Be safe, and I look forward to catching up with you in the next episode. I want to wish you good luck with your studies. Hello there. I hope that you're doing well. Welcome to the fifth and final episode of the swing trading series for my 2025 mentorship. During this episode, I will summarize everything which I shared prior during this series and I will provide you with a rule-based system which you can follow in order to form your swing IDs. First of all, let us take a look at the intra-week trading framework. In order for us to determine whether or not the intra-week trading framework is in play, we must first determine key levels based upon weekly and daily charts. These key levels are time-based liquidity pools of bigger time cycles, and next to that, you must determine weekly and daily arrays. What I mean by this is the following. You must determine where the higher time frame breakers, imbalances, etc. are. Because based upon the reactions to these time-based liquidity pools and these higher time frame arrays, you're able to gauge the order flow and you're able to determine whether or not price is bullish or bearish. Utilize weekly, daily, or session SMT to confirm reversals. This means that we're going to be paying attention to SMT relative to weekly highs and lows, or daily highs and lows, or session highs and lows to confirm market reversals. If you do not understand what SMT is yet, I highly suggest you to go back through my mentorship's content and investigate the topic of SMT. The reason why I'm not going to explain it in depth during this episode and throughout this whole series is due to the fact that I'm speaking to someone who has already gone through the majority of my mentorship's content. And that is what I warned you for throughout the beginning of this lecture series as well. This lecture series is not meant for a complete beginner to just watch and think, okay, this is it. Nope. This lecture series is meant for the person that has already gone through the 2024 model series and has already gotten a good foundation when it comes to everything which I teach. I want you to focus on the days with high impact news. This means that you're either going to look for opportunities on the days with high impact news, or you're going to look for opportunities on the day in advance of the high impact news. And I will explain that by utilizing the following example to you. Let's say that you see the market reach a point of interest on Wednesday, and you know that on Thursday we have a high impact news driver. On Wednesday, you see everything which you need to see in order to confirm to you that a high of week is forming at that point of interest. You see all the signs that confirm to you that a reversal is in place. The moment that we then begin to see displacement towards the downside and you begin to see IPDA tipping its hand to you, that right there is the first entry opportunity. And the reason why is because we're then anticipating that the news will get utilized for distribution purposes, where news won't manipulate, but instead be utilized to distribute towards our objective. The process for the intra-week model. First of all, you must determine the monthly order flow. You must determine where we drawn towards for the upcoming month. Are we drawing higher or are we drawing lower? Secondly, you must determine the days of interest based upon the economic calendar. This boils down back to knowing what days consist of high impact news or what days we are likely going to see major repricing taking place. Think of events such as the Big Three. Thirdly, when a new week opens, I want you to annotate the previous week's high and the previous week's low. The reason why we do this is due to the following. You must understand that when that new week opens, the first two reference points which we have are the previous week's high and the previous week's low. The reactions to these levels will tell us the story for the upcoming week, because the past week tells us how the upcoming week is likely going to deliver. And that is a crucial insight which you must gain. And when you fractalize this as well, you should smile, because when a new session opens, you should pay attention to the previous session's high and low. Throughout the week, monitor the reactions of the previous day high and the previous day low. The reactions to these levels will tell you the story for the upcoming days. The reason why is because Monday sets the stage for Tuesday. Tuesday sets the stage for Wednesday. Wednesday sets the stage for Thursday, and Thursday sets the stage for Friday. Based upon the monthly order flow and the weekly profile which we're anticipating, we can anticipate when our opportunities will present themselves. And this boils down back to what I discussed within the Predicting Price series. Determine weekly and daily PD arrays, and based upon the reactions to these arrays, you'll be able to gauge the order flow. Determine the weekly drawing liquidity, the DOL. meaning where's price drawn towards for the upcoming week. If this variable is not clear, and it's not clear to you where price is drawn towards for the upcoming week, it means that you're basically just dancing in the middle. And let me tell you something. If you try to dabble in the middle when you don't have any idea of where the market is drawn towards, it doesn't matter what array you use, it doesn't matter what PD array you use. At the end of the day, your trade ideas will not play out. The reason why is because price is just chopping back and forth, back and forth. Whereas, however, when the drawing quality is very clear and you are very bullish, for example, then any discount array can get utilized for a long opportunity. So that's a very important paradigm shift which has to take place. Establish the point of interest for a fractal market maker model. Let me explain. What you hopefully have come to realize by watching this series and having watched the 2024 model series is that the approach to swing trading is actually very similar to the approach of an intraday trader. However, where an intraday trader uses the point of interest to drop down into a 1 minute time frame or into a seconds time frame, right? To look for that fractal market maker model from the retracement higher, for example, followed by the expansion lower, that would be that fractal market maker sell model. A swing trader would just enter inside the point of interest. It would enter near the high of that retracement. Think about that for a moment. Do you now understand why I said to you, even if you're an intraday trader, you should watch this series? And I'm telling to you, only 20% of all my mentorship students are participating in this series. Isn't that fun to think about? Isn't that crazy to realize that so many people just look at the label? They look at the label, oh, swing trading, I'm an intraday trader, I have no interest in swing trading, so I'm not going to watch this series. Whilst in reality, they're missing out on all these gems because I'm literally telling to you how to navigate the weekly and monthly order flow. Because once you are able to navigate the order flow on these higher time frames successfully, what is likely going to happen on the lower time frames? It will be easier for you to align yourself with icttrading. Look for manipulation against your drawing liquidity into your point of interest from a key open, whether it be the London session open or the morning session open. Is it possible to trade during Asia? Is it possible to trade during PM? Yes, however, the majority of the opportunities which we are going to look for intra-week present themselves during either London or the morning session. Now, when it comes to the statement of look for manipulation against your drawing liquidity into your point of interest from a key open, what I'm trying to say by that is the following. What you need to understand is that when it boils down to the idea of we have a drawing liquidity, for example, below market price, we must look for a point of interest above market price. Because what will happen is that we will look for manipulation into that point of interest, a run higher, to trap everyone into believing that higher prices are next. This is the engineering of liquidity which is taking place, so that we can then go short against that. We trap buyers into believing a false idea, so that we are able to open up our short positions against that. Then when the point of interest gets reached, after that key open, look for SMT at the point of interest. The SMT at the point of interest confirms to you that price is in fact going to turn around and draw towards the opposing side of liquidity. The entry takes place either in the point of interest or the moment a breaker or mitigation block gets created. This breaker or mitigation block can be created on the time frame that you're looking at, but it can also be, for example, a lower time frame. However, I suggest to stick to one time frame for execution purposes. And the reason why is because if you try to change it up too much, you're going to notice that one setup is cleaner like this and one setup is cleaner like that. But at the end of the day, you can either just enter at that POI with a wide enough stop or look for that bearish breaker to originate from that POI. In general, I suggest paying attention to the POI and based upon the reaction to that, determining whether or not there's an entry opportunity. If you want to, you can go down into the lower time frames to look for that break or mitigation block. But the issue that you then might find is that you're actually changing from that swing trading approach to that intraday trading approach. Does that mean it's not possible? Now, is it possible to go into the lower time frames and look for that breaker or mitigation block creation and use that as your entry from your point of interest? Yes, it is possible. However, why would you make it harder on yourself instead of just focusing on doing that what is easy and focusing on the higher time frames? Risk management. And this right here is a very important slide, so don't skip over this. I suggest using 2% risk per trade when it comes to a swing trader's approach. And the reason why is because with swing trading, what's very important to note is that the frequency of trades is decreased relative to an intraday trader. That means that we're likely going to take less trades on average per week and per month. This allows us to increase the amount of risk per position because we are only going to play in on high conviction ideas. It's the same, of course, for an intraday trader. However, because the frequency of trades is less, we can permit ourselves more risk per position. If in drawdown, decrease the risk to 1% until the drawdown has been recovered. That means that if your idea doesn't pan out and you were wrong about your analysis and you take a stop out, that means that for the next idea, you must decrease your risk to 1% until the drawdown has been recovered. Let us take a look at a visual representation of the bullish intra-week model. Here we can see the open of the new week. What I want you to see right here is that when this new week opened up, we saw the market initially run lower and it draw towards either a previous week's low or a previous day low. This means that we have already defined where these key liquidity pools for sell-side liquidity pools are resting. Next that you can see that we have determined where the key buy-side liquidity pools are, up here. The market drops lower into a point of interest. And this drop lower is so important to note because we are bullish for the week, meaning we're expecting higher prices. So what we're looking for is manipulation lower into that key sell-side liquidity pool, into that higher time frame key level, for example, a higher time frame imbalance, so that we can then see the low of week form in this area, so that the market can begin to expand towards the upside and draw towards the previous week's high or the previous day high. Now, the reason why I've not put in just the previous week's low or the previous week's high is because what I'm showcasing to you here is fractal, meaning you can utilize any time cycle of your choosing. And that right there is the most beautiful level of understanding which you will hopefully get towards one day, where you come to realize that it doesn't really matter what time frame you're on, because time is time and price is price. The only difference between all the time frames is the duration between the time cycles, meaning the duration between the highs and lows forming of the previous cycle. For example, when you're looking at a daily cycle, it of course takes 24 hours to form those daily highs and lows. However, when you pay attention to a 90-minute cycle, what you will notice is that it only takes 90 minutes to form those highs and lows. So what you begin to understand then is that the only thing that's different is the amount of time, but the underlying logic of paying attention to that previous cycle high and low remains the same. Now, how is price different? Well, price is the same when it comes to the creation of the arrays, of course, but the only thing that's different is the size of the ranges due to the volatility on the higher time frames versus the lower time frames. However, what we see is that the market drops lower into that key sell-side liquidity pool. That is our point of interest, which is being reached as well below there. And we then see the market form that smart money reversal before we see the market expand towards the upside. Look for SMT right here inside of the point of interest. This SMT can either be relative to that sell-side liquidity pool, to that previous week's low or that previous day low, or it can be SMT inside the smart money reversal. That SMT inside the smart money reversal would be, for example, just an SMT right here on the absolute lows. And next that what you would be paying attention to is when both apply. If you see both SMT relative to the previous week's low or previous day low, and you see SMT inside of the SMR, this is called double SMT. And this is the strongest form of confirmation which you can have for an SMR being in play. The entry area is anywhere below the opening price right here. This can be the opening price of a week. This can be the open price of a day. What I'm sharing with you right here is that we look to enter below the opening price or at it, just in close proximity to it. And the reason why is because we're buying it in a discount relative to that opening time. And notice that I'm sharing with you that the opening time is up to your choosing, meaning it depends on what you're framing the trade idea on. If you're framing it for a weekly swing, then you would much rather be inclined to use the weekly open, and of course the previous week's low and the previous week's high. If you have, however, already established that you're bullish for the week and that you're looking for a long idea, you can utilize the previous day's low as a level to monitor the reaction of, in order to determine whether or not a trade idea is going to pan out and whether or not you are going to see the market draw towards that previous week's high or that previous day high. Here we are on the Nasdaq chart. And what I want you to see is that the Nasdaq expanded above this red shaded box. If we pay attention to the left right here, you can see that this red shaded box was this CB right here on this chart. Notice that the market expanded above it and continuously found support inside of it. It found support inside of that area right here, and right here. Notice that we formed the high of month right here of the previous month, and we saw the market drop lower. The new month opens up, and where does the market open up in? It opens up inside of the price range of that old CB. And what you need to know is that when we displace above a CB and we have key buy-side liquidity pools which are still yet to be ejected, we can anticipate that the market is going to retrace into that price range of that old CB, find support there, and then continue the bullish order flow. What you can see is that the market formed a low inside of this CB again. And what did the market do? It expanded towards the upside. It expanded towards the previous month's high. Why is this previous month's high an important buy-side liquidity pool? Because of the fact that it got engineered in advance of the old autumn high. So you have a monthly high right here, and next to that you have an old autumn high right here as well. So you have two key buy-side liquidity pools that are too close to each other that we can anticipate them to be ejected. Now, when we pay attention to the RE chart then, what you can see is that on this RE chart, you can see that the market dropped lower into that CB's price range. We see the market just go back and forth there for a while. And your eye might be drawn towards everything around the right here. However, I want you to focus on the delivery which took place on the left. Notice how the market consolidated up here, forming that monthly high. And then we saw the market expand towards the downside. A retracement takes place, and we see two imbalances get created in a row right here. I've only annotated the higher one right here, but notice that there's also one below here. When you see big down close candles on the left side of the curve into your point of interest whilst you have a bullish bias, whilst you have a bullish thesis, what you can anticipate is that these big down close candles are representing manipulation that are taking place. Meaning you can see that two CBs are getting created, and it shows to you everyone is being trapped into believing lower prices are next. We see the market consolidate inside of that CB, and eventually we see the market begin to displace towards the upside, and we begin to see it run towards buy-side liquidity, resting above the previous month's high and eventually beyond. This was also around the period that President Trump was elected. Now what you can see is that I've annotated the previous week's low, which formed inside of that day CB right here. What we will do is we are going to compare Nasdaq to ES. On the left you can see Nasdaq, and on the right you can see ES. Notice that on the left you can see that Nasdaq never took out the previous week's low, meaning it created a higher low. However, when you pay attention to ES right here, what you can see is that ES took out the previous week's low and then began expanding towards the upside. That right there is SMT relative to the weekly low, and that confirmed that we were forming a low inside of that old CB's price range, and that means that we're likely going to see the next expansion leg higher taking place soon. When we go back to this chart then, what you can see is that I've annotated the high which formed inside of that CB. Notice that the market repriced above that high right here, and that by itself is already the first entry opportunity. The reason why is because that is icttrading tipping its hand to you, that's in fact in the buy program, after the SMT. That's very important to note. You have framed the idea of a weekly low being inside of that higher time frame array, inside of that CB. You have seen SMT take place inside of that point of interest, after you have already defined that the drawing liquidity is above market price at the previous month's high and at old autumn high. So the moment that icttrading reprices above the high which formed inside of this CB on the left right here, this is already icttrading tipping its hand to you, and that is the first entry opportunity. A stop loss can be placed below this candle's low. Look at the size of this candle, and next to that what you can see is that an REBC got created right here. If you wanted to wait for the creation of that imbalance, you could have entered right here inside of that imbalance, increase the potential risk to reward on the position, and move from there. Notice that the market repriced above this RECB right here, And notice that when we tapped above it, the market found support inside the price range right here. And eventually we saw the market expand higher significantly, and we saw this imbalance get created. Notice that the market opened low for the next day, for the day of Wednesday, and we saw the market eventually reprice towards the upside. Do you see how this was also a potential entry opportunity anywhere in this area? Where you begin to see that the market reprices away from its imbalance. A new imbalance gets created right here, which I did not annotate, but pay attention to the direction to the midnight opening price right here. Whenever you are trading within a market maker buy model or sell model, within any market maker model, you will see so many entry opportunities, and that is why it's crucial to truly understand them. And when you pay attention to ES as well on the right here, what you can see is that Nasdaq reached that midnight opening price whilst ES didn't, and that right there is open SMT, and that confirms to us that that next expansion leg towards the drawing liquidity is going to take place. So that's a good gem for you in here. Now let's take a look at the bearish intra-week model. The bearish intra-week model is basically the bullish model inverted, meaning what you first of all do when the new week opens up is you must determine, alright, are we bearish for the upcoming month? If we are bearish for the upcoming month, you must monitor the moment that the new week opens up where the previous week's high are and where the previous week's low are. If we have determined where these liquidity pools are, we are going to monitor, is there any higher time frame array above the previous week's high? If there is, that means that the previous week's high is engineered by such liquidity. When price stops right in advance of a higher time frame array, you know that that is the engineering of liquidity which is taking place. And what occurs after that engineered liquidity has been taken out? After that, you're likely going to see all the signs which you need to see in order to confirm it SMR. We see the market run up higher into that point of interest, into that higher time frame key level, and we begin to see the signs of a high forming in this area. Then the market displaces below the opening price, retraces, and we then begin to see the expansion leg towards the opposing side of liquidity. Now again, as outlined, this depends on where you're framing the setup, because if you're framing it from, let's say, the beginning of the week, from Monday and Tuesday, you're going to see the week open high. However, if it's already Thursday and you want to participate in that final run towards your higher time frame drawing liquidity, then you could use the logic of paying attention to the Wednesday high, its reaction, and then based upon that, monitor whether or not you're going to see a purge and revert. Everything boils down to recognizing where's the manipulation taking place. Because when you can recognize manipulation, you can anticipate the distribution which will follow. Now, when we pay attention to that same schematic, but I put on the following note, what I want you to see is that we can see that the market has formed SMT relative to the previous week's high or the previous day high, or there's SMT inside of the SMR, or there's both. And when there's both, it's called double SMT. And when you see this, all the stars align. And that is where we want to see all the magic come in place, so to say. Because when I see double SMT, that to me is the ultimate confirmation of the confirmation taking place of a swing high formation. Now look for SMT at that exact reversal and look to find your entry above that opening price or in close proximity to it, as you can see right here. Why? Because we're looking to position yourself short in the open high. That is very important. Open high, guys. Now let us take a look at the higher time frames for a moment and let us pay attention to GU. What you can see right here is that I've annotated on GU this specific imbalance right here. Notice that the market expanded lower a lot before eventually forming a low and drawing towards the upside. Notice that we repriced into that imbalance already right here, and we saw the market reject it. Notice, however, that this rejection was not sustained, meaning we saw the market eventually form a low and drop back towards that old imbalance. Does that mean we all of a sudden turn bullish? No, we can still utilize that same old imbalance to look for rejections to take place of. Meaning, as long as price does not displace above this imbalance, I'm anticipating a rejection to originate from that same range. Notice that I've annotated the previous month's high right here, and we then saw the market expand towards the downside significantly, originating from that green box. Now, when we pay attention to the RU chart, what you can see is that I've annotated the previous month's high, and what you can notice is that the market repriced into that higher time frame imbalance many times where you can see that it just repriced into it, rejected, repriced into it, rejected, repriced into it, rejected, repriced into it, rejected, etc. What this is showcasing to you is that every single time that price is entering this area, shorts are being filled. And high frequency trading algorithms are doing one thing. They're shorting, they're shorting, they're shorting. They're positioning themselves short for that high time frame swing high, which is likely going to form so that the market can be repriced towards the downside. Market is consolidating, and eventually the month of February opens up right here. February opens high, forms the high right here, then begins to displace towards the downside. Notice that the market displaces through this imbalance which formed right here. We see this CB get created. We already framed the idea of the market likely rejecting that imbalance from the higher time frames. The reason why is because we haven't seen price displace above it, so we must anticipate, alright, we're likely going to reject it. Price is either going to continue through it or it's going to reject it. And when it's not showcasing to you that it's continuing, we're likely going to see that rejection take place. We see the market create this CB right here above the February open, above the new month's open, and therefore we can anticipate that we're likely going to see the market retrace into that CB, and there we are likely going to see that lower time frame sell program unfold from. Notice that the market wicks above the CB, but notice that the body goes below it. This right here is an entry opportunity. The reason why is because we're entering inside of a premium array, which got created throughout the London session. And that right there is a gem. Pay attention to when your arrays are created, during what session or what time. And we begin to see the market eventually roll over. Notice that the stop can be placed above the previous day high, because if we're in fact in a sell program now, and if we're in fact likely going to see GU begin to roll over, what we can anticipate is that we're likely going to see the market begin to draw towards sales liquidity. And in order for that to be the case, when we have already reached a higher time frame array, we're likely going to leave those previous daily highs intact, because there's no need for the market to get back above them anymore, since the order flow has already changed from bullish to bearish and all the liquidity has already been taken from the higher time frames. We see the market expand towards the downside and it trades below this down close candle right here. This down close candle by itself is again a potential shorting opportunity. The reason why is because it was a previous weekly low. Pay attention to the previous week's range from Monday to Friday. Notice that the low of that week formed right here. That means that if we're in fact in a sell program now, we are likely going to see that the previous weekly low function as resistance on price. This is my continuation time cycle theory in action, where you see that the previous X low is functioning as resistance on price once this plays through, which tells us that the order flow is still bearish. If this was not the entry yet, this would have been a potential entry. Stop loss would have been placed either above this down close candle. However, to play it safe, what I suggest doing is going a few pips above that or even above the February open and moving it from there. Now, let's say that you took this first entry. How would you manage this? The moment that price displaces below the previous week's low, you can immediately trill your stop loss to break even. Why? Because the next entry is taking place right here. And the invalidation of that idea would be if price would come back all the way up to this CB right here. And that's a very big light bulb moment for some of you which is taking place. Because you need to note down in your notes that trade management, yes, is the following. You manage your positions by paying attention to where the next entry opportunity takes place. That next entry opportunity has a new invalidation, which is usually around your initial entry. Now you begin to understand how I'm able to pyramid into my positions. This is something which I will discuss more throughout the 2025 mentorship series, in which I'm going to share with you a full model that allows you to pyramid in and out of positions as well, when it comes to scaling up when times are good and scaling down when IBDA is showcasing to you that things are not as pretty as possible. Now, let us move on to the following chart. What you can see right here is that on the left you can see GU, on the right you can see the dollar. What you can notice right here is the following. What you can notice is that I have annotated the previous monthly high on GU inside of that high time frame imbalance. And next that you can see that I've annotated the previous month's low on the dollar. What you can notice is that GU created a lower high relative to that previous monthly high. whilst the door created a lower low relative to that previous monthly low. This right here, guys, is SMT relative, yes, to that monthly high on GU, or that monthly low on the door, of course, depends on how you view it. Because what should have occurred is the following. What should have occurred is that GU created a lower high, whilst the door created a higher low. But because the door also created a lower low, that right there is SMT, which is taking place relative to a monthly low, and therefore that's a lot of time between those periods of time, and therefore we can anticipate that we're likely going to see the market reverse soon, especially when you consider time and when you consider where we were at relative to price. Now, let us dive into the process for long-term trading. The visual representations of the process for long-term trading are exactly the same as the intra-week trading, but the only adjustment which is being made is what the liquidity pools of course are. However, when it comes to the process, we have some few things which we need to monitor, and those are the following. First of all, we determine the yearly order flow, meaning we determine where the market is drawn towards the upcoming year. This means that we pay attention to very high time frames, and then we can be monitoring monthly time frames, maybe even quarterly time frames or yearly time frames in order to get an idea of where the markets are drawn towards on the highest possible time frames. Next step, we determine longer term narratives being in play. A longer term narrative is basically a narrative that the media is actively trying to push when it comes to changes that are taking place. This doesn't necessarily have to be something which is very well known to the majority of people. However, you must be able to recognize trends. And this is a topic which I might discuss in the future within separate topical lectures, where we can pay attention to swings which are taking place, where you can see that the masses are being led to believe a false idea, while smart money is doing the opposing on the back end. And that is something which we will discuss later down the line. And what I mean by backend, by the way, is behind the scenes. When a new month opens, annotate the previous monthly high and the previous monthly low. This means that the moment that new month opens, you immediately have those two reference points, just like with that weekly open. Above the previous month's high, buys liquidity has been engineered, and below the previous month's low, sells liquidity has been engineered. Throughout the month, monitor the reactions of the previous week's high and the previous day's low. This means that if the market is not in close proximity to the previous month's high and or the previous month's low, monitor the reactions to the weekly highs and lows to gauge the order flow for this month. Determine monthly and weekly PD arrays, meaning determine where your higher time frame imbalances are, determine the monthly draw on liquidity, the DOL, and next step, establish your point of interest for a fractal market maker model. When you have determined a draw on liquidity below market price, you will be looking for a point of interest above market price. You will be looking for open high into that point of interest. This is trapping people into believing higher prices are next. And then you are going to look for the signs that confirm to you that we're likely going to see the market draw towards the downside soon. Look for manipulation against your draw on liquidity into your point of interest from the weekly open. However, this weekly open could also be adjusted into, for example, your monthly open if you're looking at a position trade for a longer period of time. Look for SMT at your point of interest, because this SMT confirms to you that the market is in fact going to turn around. Entry either in the point of interest or the moment that the breaker or mitigation block gets created. Now, the only adjustment which has been made relative to the intra-week model is the fact that a swing trader that is paying attention to long-term trading is focused on participating in very large price swings, and therefore the duration of the time cycles which he is referring to are also very big, of course. And that is a perspective shift which has to take place, where you begin to understand that everything forms in each other. Meaning, if you're able to establish your higher time frame analysis and you're able to align yourself with that on the lower time frames, you are going to see a level of precision that's unmatched. And that is what I'm interested in when I'm looking for setups myself. I don't really care about going against the higher time frame analysis. Can I? Can I look for opportunities against a bullish bias and look for shorts? Absolutely. However, where do you think the lowest possible resistance security runs are going to take place consistently? On the upside, of course. So why would I look to short against that, right? Focus on aligning yourself. And what I want you to do is I want you to go into your own charts. I want you to investigate everything which I taught you during this series. I will not share with you the schematics for the long-term trading model as separate schematics because they're exactly the same as schematics which I outlined prior. The only adjustment is, of course, that you're paying attention to, for example, a previous monthly high and a previous monthly low, and you're paying attention to just bigger time cycles in general. But besides that, everything stays the same. I'm 130% certain that when you go into your own charts, you're going to be amazed by the level of precision when it comes to these higher time frame swings. And then it's up to you to decide what to do with that information. I want to thank you for watching this lecture series all the way to the end. I hope that you enjoyed it. As outlined, only 20% of my mentorship students are participating in this series. So that means that you are one of that 20%, and I congratulate you for that. Even if you're an intraday trader, I'm sure that you have gotten massive value from this series when it comes to higher time frame analysis being made. And if you ever want to get into swing trading, this is how I would invite you to investigate it. I want to wish you good luck with your studies. I want to wish you good luck with going into your own charts and trying to look for these high time frame swings. If you have any questions, feel free to reach out to me through the mentorship form, and I look forward to seeing your development. Good luck, and I highly suggest you to pay attention to the 2025 model series as well. Be safe.